Dear colleagues, welcome to the second day of Economics of Payments. Before we start with the first session, I would like to ask our Director of Cash Management, Equity Interest and Internal Service Department, Matthias Schroth, to give us a welcome address for this day. Matthias, please.
Good morning, ladies and gentlemen, and welcome back here in our central bank. I hope you enjoyed the dinner as much as I did yesterday. And I have to tell you, as a lawyer, I always really appreciate the exchange with the economists, because economists and lawyers, I think we both are able to raise more questions and problems in one sentence than we ever can solve in the whole life. So thank you very much for this inspiration. So some of you may remember that cash is a means of payments. And if you have forgotten it, then I can tell you Austria is the perfect place to refine it, that cash is still alive and that cash is an important means of payment. But of course, cash is no longer the king. We have to admit it's also not in Austria. The figures are decreasing, and it has, of course, no monopoly status at the point of sale as it has had maybe 20 years ago. And of course, we have also here the discussions like it's old, it's outdated, is there any future for it, will we need it anymore? And of course, the time is too short to go into the details, but I also want to raise some questions here now without answering them. So, I mean, what will the future bring? Of course, the world will get more and more digital. This is very obvious. But how in detail, how much non-digital world we will keep for us as non-digital human beings? Yeah? This is the question we will see in 10, 20, 30 years. Think about the mobility. 50 years ago, everybody was talking about the mobility. And mobility is very important. Yeah? But the mobility, because of mobility, we were building huge roads in the city. We were building highways and freeways, and even more we planned and we didn't build them. And nowadays we are very happy that we didn't build them. And especially here in Europe, we are rebuilding them because we know that we need more space in the inner cities for pedestrians and also for the bikes. And if I ask you, what has more future in the inner city as a transportation system, the bike or the car? Then what would you answer? What would young people answer? And would we get the same answer we got 40 years ago to this question? I'm not so sure about this. So mobility is important, but how we live the mobility has changed over the time. Digitalization is important, but how it will come exactly, we will find out in the future. It's also about the question, we say, yeah, but cash maybe will be not longer available in 20, 30, 40, 50 years. But what is with cards and smartphones? Are you 100% sure that one day cards and smartphones will only be found in museums? What is my guess, to tell you the truth? What's about transportation when we talk about trains and airplanes? What is the modern technology? But what is, if you think about global warming and climate change, maybe the technology which will help us to succeed at this problem. Think about the radio. The radio had a monopoly status in the 1950s here in Europe. And despite TV, internet, video, streaming, the radio is still not dead. It's still alive. It's the same with the cinema. The cinema is dying since I was born 50 years ago. So, but there's only one thing what is very important. There was always someone who was taking care of the product, about the infrastructure, about the reputation, about the communication. And this is also what we think is important for the cash to think about, to keep it alive. And sometimes I have to tell you, as I see how cash has been treated over the last 10, 15 years, it is somehow a miracle that there's such a big demand there, which shows, in my opinion, that cash is a great product. So I'm coming almost to the end. So we in Austria, we are taking care of it. We're taking care of the infrastructure, of the communication, and we want to keep it alive as one means of payment and a modern one. A non-digital one can be also modern. And yeah, my time is over now, and the time is over for cash is king. but it's also the speaking time over now. But I won't let it go without telling you the new approach we have here in Austria, and this is cash is queen. Thank you very much.
So, and with that, I would like to open the first session of the day, and I'm delighted to ask for Lorenzo Spadavecchia from Bocconi University to give the first talk, which is Back to the Bank, Digital Currency, Deposit Substitution, and Credit. The floor is all yours.
How do I change the slides? From there. Okay, thanks a lot for being here. So I'm presenting my paper with two economists at the Central Bank of Uganda. It's called Back to Bank, Digital Payment, Deposit Substitution, and Credit. So just to provide a big picture of my research agenda, what I try to answer in my papers is what specific frictions and constraints prevent the development of financial markets in low and middle income countries. And especially, how can policy affect this? So what's the subject of my study? The subject of my study is called mobile money. It is a system that allows you to exchange money through mobile phones. It's quite widespread in most developing countries, especially sub-Saharan Africa. So just to give you some numbers, nowadays in sub-Saharan Africa, about more than 55% of adults use it, and every day are exchanged the equivalent of $3.5 billion. It is very widespread for a very simple reason. So the only thing you need to exchange money is that kind of phone. So you don't need a smartphone, you don't need an internet connection. So some of you might recall it. I'm happy to be young enough not to remember it, but still you just need a very simple phone, and the technology is based on 2G, so not on internet connection. And this is very important, especially for financial inclusion, because many people in rural areas, for example, have this kind of phone. They don't have access to internet connection, but they can just exchange money by testing, for example, Lorenzo, $5, and then they can send money. There is already a bunch of literature on this topic. They focus mainly on things of development economics, so risk sharing, saving, remittances. Just to make an example, before the introduction of mobile money, so we're talking before 2010, people used to send money from urban areas to rural areas, and the only way to send it was, for example, through buses. They literally shipped their cash on buses going from city centers to rural areas, and this money obviously could either be stolen. The service was very costly, for example. So mobile money got a surge because of the possibility of sending remittances very easily. However, the academic literature doesn't focus much on regulation. There are not many papers on regulation, and here is where my paper comes. So what I study is a very hot topic in sub-Saharan Africa, which is called digital money tax, which is practically a tax on digital transactions. So governments are agreeing now to put this tax on each mobile money transaction, for example. And this is what happened in Uganda, for example, which is the case study of my paper. Obviously, this tax has some pros. It is a very easy way to finance the rising national debts of sub-Saharan governments. There is also the need of formalizing the informal economy. So by putting a tax on transactions, it's very easy. But this tax, it's easy. But yet, there is no evidence on who this tax is burdening. So as we were saying, the system is mainly used by poor people in rural areas who have no access to other financial systems. There are no bank branches, for example, in rural areas. So they only have access to mobile money if they want to use a digital financial service. However, the question of my paper, I wanted to focus more on how this tax affected the competition with traditional systems, in my case, with traditional banks. So let's go on. To frame my, let's say, my research question in a more academically way, I want to answer this question. Do digital currencies disintermediate banks? If so, how does this affect the credit market, and how can this affect financial inclusion? So to wrap up my paper, I have a toy model of currency substitution. I present a trade-off between convenience of storage and transaction cost. I'm not presenting the model here for matters of time. Then here comes my identification. My identification, I wanted to use the case study of Uganda, and it took me 2 years to get the data. But it's very interesting because the tax in Uganda was literally introduced overnight. The government surpassed any kind of regulatory framework, and the tax was not anticipated by users. They just introduced it one day when the government decided to put such a tax. For my identification, I use geographical heterogeneity in access to substitutes of mobile money. I will better explain it later. And what are the innovations of my paper? What I present is evidence of substitution between bank deposits and digital currency. And then I need to say that I'm the first one using administrative data on mobile money, and I have access to the full universe of mobile money transactions in Uganda. What I will show in the final outcomes is a liquidity shock, so how this passage from mobile money to a digital, so from a digital currency to bank deposits affects banks through a positive liquidity shock. This, of course, will lead to a change in credit provision. So I will try to provide you with a general framework of what is happening in Uganda. This is what we discussed with the central bankers. So let's think to be in the pre-policy period, so where everyone is using mobile money. So users are using mobile money for deposits. So how does this technology work? I want to spend more time here. I will go through the results very quickly, but it's important for those of you who don't know mobile money to understand how it works. So mobile money is provided by telecommunication company. So let's think of Vodafone or whatever, providing this kind of system. You can open a sort of account within your SIM card. So you can load money on your SIM card. In order to load money on your SIM card, you just need a phone number. So it's very easy to use. So there is not all the bureaucracy, for example, that is needed to opening a bank account. So this is another reason why people in rural areas have easy of access to this kind of system. Sometimes they don't even know like English, for example, in the case of Uganda, so they cannot even sign the papers needed for a bank account. But in this case, they just need a sort of identification, which is provided by the telecommunication company, which is the phone number. So in order to deposit money, and in order to have mobile money, how can you do that? So there are people who provide a service for the telecommunication company, which are called mobile money agents. So it's a person who decided to have a contract with a telecommunication company and become an agent for the telecommunication company. So these agents are money managers. What happens? You go to the money manager, which are literally people who put an umbrella in the middle of a street and they provide this service for a telecommunication company. You go there, you give them cash, and they give you a same amount of mobile money to load on your SIM card. So you provide to them cash, then they store cash afterwards into the telecommunication company account, which I will explain it later. It's an escrow account, and this money of the telecommunication company cannot be used for anything. Telecommunication companies have an escrow account inside the banks, and that money cannot be used for anything because the central banks need to know in every exact moment the amount of mobile money in circulation. And so you can store cash in the mobile money, and this is loaded into your mobile money account. Then, with this mobile money, you can make payments. Then the tax comes. Now, in Uganda, there is practically no POS, so people cannot really pay with cards. So the direct competitor of mobile money for payments is cash. Then, let's say that the economic literature in developing economic agrees on the fact that it's not safe to keep the money on the mattress. There is a risk to carry your cash with you. So people need to store it somewhere. And the only place to store it, if it's not mobile money, becomes bank deposits. Now your question comes. So why did bank deposits never take up before? So why were people not using bank deposits before? So as I was saying, there are no bank branches in rural areas, for example. But also, there is a new thing in Uganda that was introduced much before the tax on mobile money, which is called banking agents. Practically, is a system that mimics the one of mobile money agents, but for banks. There are people who can make a contract with a bank. They can go, for example, in rural areas and provide banking services for the bank. So they can allow you to store money in the bank or to open a kind of bank account. So for example, you can go to a banking agent, give to them cash. They will give you an account number and a PIN, and then you can go to any ATM, insert your bank account, insert your PIN, and withdraw the money you provided to the banking agent. So this is a way for banks to go to rural areas. However, as I was saying, this is very demand-driven in the sense that these people are not direct employees of the bank. These are people who decide to provide this service autonomously. It's a contract they do with a bank. It's a service contract. So what I will show in the paper is that there is an increase in deposits through this technology, through this new technology of the banks. And where do bank deposits grow the most? Where there are ATMs. Because as I was saying, if you need to pay with cash, you also need to withdraw money. So you go to the banking agents, you need to deposit cash. But if you want to pay, since there are no POS, you cannot pay with card, so you need to pay with cash. So you will be able to pay with cash where there are ATMs. So if there is a high density of ATMs, you know that there is a place where you can withdraw money nearest to the place where you need to make the payment. So there is no need to carry cash with you. So there is complementarity, let's say, between ATMs and banking agents. So just to wrap up the paper in a slide, so you see the blue line, it's the value of mobile money accounts before the tax, and you can see it on the left axis. Right after the tax, like in the weeks after the tax, you see a drop in the mobile money accounts value. If you see bank deposits through this banking technology, after the tax, you see a surge in the deposits made through these banking agents. So the literature I want to insert myself is the one of central bank digital currency. I provide empirical evidence on the introduction of a kind of central bank digital currency. And then I provide more evidence on in the literature of mobile money regulation. And I provide new data and effects of a widely discussed policy. I also want to cite another paper I have with Professor Brunnermeier. We study another policy, which is called interoperability, so which is the possibility to exchange money between different mobile money providers, which is another very discussed policy. The rest of the presentation, I will provide information on the data and on my empirical analysis. So for the data, as I was saying, I have access to the universe of mobile money transactions. I have information on the location of a random sample of 10% of users. I use information from the Uganda National Panel Survey. I have information from the banking agents, so I have district-level data at monthly level for the banking agents. I have a bank's balance sheet at monthly level, and a very nice data set on the full credit registry of Uganda. So as I was saying, my identification is based on the introduction of the tax, which induces a shift in technology, and I use a geographical variation, which is the presence of ATMs, as heterogeneity. So I interacted the dummy for the introduction of the tax with a measure of variation for ATM density. So I provide evidence at user, household, district level, and also at bank level using the bank's balance sheet data. So just wrap up the mechanism. I will rush through the results, but I want you to have a grasp of a general idea. So the mobile money tax increases the cost of mobile money and leads to a decrease in the usage of mobile money. Also, the mobile money tax triggers a shift in technology, so the banking agents, and there is this adoption of bank-related technology, which leads to an increase in bank deposits, an increase in the usage of cash, and an increase in ATM withdrawals. There is a liquidity shock, so banks have access to new liquidity, but which has a very high turnover. So this new liquidity is very highly demanded for making new payments. This leads to an increase in the credit provided by banks, but this new credit will have a loan maturity, and I will also show that it has different characteristics than previous credit. Now, all the analysis I provide is based on an event study specification and difference in difference. So all the results you will see now have to be interpreted as the differential effect that the tax had on units with high ATM density with respect to units with low ATM density. So first results, mobile money. What I show is that after the tax, individuals living in districts with high ATM density experience a higher decrease in the usage of mobile money by 10%. So people who have access to substitute will decrease their usage of mobile money more than other people. So what I'm saying is that the people in urban areas where there are high ATM density will decrease the usage of mobile money more. I provide evidence at different difference. I also provide evidence with panel survey data. Then what I show is the increase in the adoption of the bank-related technology. So you will see an increase in the number of these banking agents, so this new technology of the banks. And I show this evidence both at the district level and at the bank level. So those banks with a high number of ATMs, we also see a surge in the number of banking agents. Obviously, because if you deposit money to a banking agent of a given bank, you also need to withdraw the cash at the same ATM of the same bank. So it's very specular as an analysis. Then what I will show is that the deposits increase. So the deposits made through this financial innovation, through these banking agents, increase more in districts and in banks with high ATM density. I will also show the Venn study. And then I also want to show this, and this confirms a bit my analysis, which is the stock of deposits. So before I was showing the inflow of deposits, so the new deposits made through these banking agents. Now what I show is, through the bank's balance sheet, the stock of deposits. As you will see, there is no effect on long-run deposits. But if you go to see short-run deposits, so demand deposits, those deposits made for demand of cash and for cash storage, you see an increase of more than 10%. It's 13 and 20%. It's quite a lot. Then what I will also show is that there is an increase in the usage of cash, and it is statistically significantly only in high ATM density. And I also show that there is an increase in the usage of ATMs. So also the event study provides evidence that banks with high ATM density experience an increase in the withdrawal of money. So this confirms, again, this mechanism for which there is high deposits, but also a high withdrawal of money. So again, the mobile money tax induces a drop in mobile money usage. There is adoption of banks' financial innovation, so these banking agents, and banks' financial innovation facilitates substitution of mobile money. Now, mobile money substituted with bank deposits for storage and with cash for payments. Banks experience a higher inflow of money, so new deposits, but also a higher outflow of money, so new withdrawals. So practically, there is new liquidity, I'm almost done, but there is higher turnover. This higher turnover of cash increases demand deposit stocks, and this affects somehow the credit market. Now, let's go very quickly to the credit market, and I will go to the conclusions. So I used the Quasi-Mian method to estimate the bank lending channel. So I introduced a district time fixed effect that clears out for the demand-driven effects of a district. I provide evidence at the district level on the amount of credit, on the term of repayment, and on the interest rate. So banks need to change their liquidity management. Why? There is high deposits, but high turnover of deposits. So this new liquidity has very high turnover. So in order to face this high demand of cash from banks, new credit has to have lower repayment terms, and I will also show that it has to be less risky, because banks always need to repay this new credit. So what I will show is that there is a transfer rate from high to low risk borrowers, and this will go my analysis on financial inclusion, let's say so. So I provide, this is no causal analysis, it's just a plot of how the credit provision of banks with high ATM and low ATM density changes over time. The black line is the introduction of a tax. This is all in log. You see that on average, the provision of credit for high ATM banks after introduction of a tax increases of about $100 million. So this is right in the trimester right after the tax. So what I will show is that there is a general decrease across all type of borrowers of the term of repayment. So as I was saying, banks need to cope with a high demand of cash, but want to use this liquidity to make new credits, and the new credit will show a much lower term of repayment. Then there is, as I was saying, a transfer of rent from high to low-risk borrowers. And as I show, there is an increase in the amount of credit made only to low-risk borrowers with an established credit history. And also the interest rate, there is a higher interest rate only for those high-risk borrowers. So let's go to the conclusion. And so what we study is the effects of digital money tax in Uganda on substitution between mobile money, bank deposits, and cash. This is a very highly discussed policy in Africa. And I am the first one, as I was saying, using the universe of mobile money transactions. There are 3 things that we learn. First of all is how digital currency crowd out bank deposits. And I practically have the opposite experiment. So what I show is that when a digital currency is taken out of a system, how this affects bank deposits. What I show is also that financial technology monopoly prevents financial innovation, and this is the case of mobile money against banking agents, so the new financial technology for banks. And also what I show is that banks facing volatile liquidity reduce their maturity and provide a transfer of rent from high to low risk borrowers. So I hope you enjoyed the paper, and thanks a lot for listening.
And it's my pleasure to welcome Tamás Briglevics from Central Bank of Hungary for the discussion.
Thank you very much, and thanks to the organizers for putting together this fantastic event. I really enjoyed all the papers and the dinner as well. And thank you for the presentation, Lorenzo. I think your presentation we didn't discuss before, but answered a lot of my points, especially this long introduction about how payments work in Uganda. I think a lot of this discussion should find its way into the paper, which would help the reader a lot, because it's a really unique setting, and it's a good one. I think it's a really good one for what you're trying to do. But me not being an expert on Uganda, and I think most readers not being an expert on Uganda, will appreciate all of this background that you had in the presentation, but less so in the paper. So the paper really is about exploiting this tax change, where the story is that there are 2 technologies to essentially deposit and withdraw cash into banks, and there's a big relative price change, and Lorenzo and his co-authors are estimating essentially a demand system where the own price elasticity is negative and cross price elasticity is positive between mobile money and agent banking. And so that's all nice and well. And this liquidity shock then further increases credit supply through banks intermediation. So I guess at face value, these are not surprising results, but obviously the question is the magnitude and what these elasticities are. The data set is amazing. I know a lot of people in the audience here who try to estimate demand for payment instruments without having price data, myself included. So I was super jealous that you can actually do this. It's really big pain to do these demand estimations without that, as many of you know, but you don't have this problem. And then sort of the broader takeaway of the paper is that whatever happened in Uganda may or may not be important in Austria or Hungary, but maybe it does tell us something about how pricing of CBDCs will work, and presumably something like negative interest rate that a lot of economists were super excited about 5 years ago, or anywhere between 20 and 5 years ago, how that would work. Okay, so as far as my comments are concerned, on the background thing, so basically what the empirical part of the paper does is a diff in diff estimation. And with diff in diffs, there's always, you have to be very careful about what's the treatment group, what's the control group, and explain that. And I think your strategy, this ATM density, is a really smart idea, and it's going to work very well. But I think you really need to explain why you don't expect any effect in the control group. I mean, of course, you cannot literally hope for that, but for example, you could show those alpha t's in your estimation table and see if those are significantly different from 0 or not. Also, your ATM density measure is something like the number of ATMs divided by the area of the region, which is kind of strange. I would divide it by the number of people living in a region. So if you think about the US, I don't know, Rocky Mountains, it's big regions, not that many cities. But within Denver, I suppose you're able to find ATMs, right? So I think you can get a better proxy for ATM availability. I saw on your website that you also have data on the cost of many different kind of payment instruments in a different project. So I think it would be important and interesting to know what the relative cost is of mobile money and agent banking or just straight up depositing, since you're estimating the demand with all these prices. And then, yeah, usage patterns, you basically explained that in your presentation. Now, as far as the estimation methodology is concerned, I have a couple of comments. First of all, you have 2 price changes, not 1. So I'm not only jealous of you having prices, but I'm super jealous because you have 2 big price changes. But I think you didn't mention in your presentation that there was a big initial increase on, I don't know, 1st of July on 2018. But then there was an outcry against it, and then these taxes were lowered in November of the same year. So there's a big increase in prices and a decrease, and you don't exploit this variation in any of your estimations. So obviously, it would be interesting to see if these elasticities are symmetric, or what happens to mobile payment use after people already adopted agent banking. Do they find their way back, or now that they have this new technology, they just say, I don't care about mobile money anymore. The second thing is with diff and diff. I like this ATM density thing, but it's essentially a continuous treatment that you have, right? And so there is literature about that and how to do diff and diffs with continuous treatments. I think you should just straight up do it. And from the data, it's pretty obvious that that the results that you're looking for is there. So you don't have to worry, but I think it's going to be easier to publish this paper if you treat your continuous treatment as a continuous treatment. In this graph that you showed, there seems to be a lot of seasonality in mobile money use. So I think somehow correcting for that would potentially help you avoid some questions from referees. And we're also not really talking about the extensive margin. So all of your estimation is based on people who kept using mobile money even after the introduction of the tax, if I understand that correctly, which probably the biggest losers when you talk about who's affected, probably the biggest losers are the ones who stop using it because it's so expensive, right? So that's also an important part of society. As far as credit effects are concerned, I feel like in this part, there's a lot of things coming together, and I think one potential driver of your results is that there's just a different mix of credits that is being offered with this new liquidity that banks get. So, it's going to be more like short-term consumption loans, and so therefore, I think it's not quite an apples-to-apples comparison, and at least some descriptive stats on what were the shares of different types of credit before and after the tax would be helpful. And yeah, you answered the final question that mobile money companies had this escrow account, and essentially what happened was that these escrow accounts were now freed in the banking system. But that should also be in the paper. And then speaking of people who have estimated demands for payment services and different payment technologies, so there's a lot of literature on how to answer the first question that you posed here, which is what is the value of these technologies, right? And I think you should, instead of doing diff and diff, you have a great data set, and you should try to estimate these demand models. I think your problem would fit into many of these different frameworks that have been published recently or not so recently, or have not yet been published. And that would definitely help you. So basically, the idea there would be that this change in prices and the response should tell you how valuable mobile money is to some people, right? And using these methods, you can tease that out. And what this literature explicitly talks about a lot is the adoption of payment instruments, and by extension, unadoption of payment instruments. And so I think that's really a very important margin that you're missing. You're also doing these estimations, the mobile money usage, the agent banking usage, and the credit thing as 3 separate equations. Actually, it's much more than 3 because you do it at the user level and district level and whatever. But even though this is one system, you're doing equation by equation estimation. You don't try to put it together into a full-fledged demand system. And actually, there's a couple of papers now where people try to bring the standard I/O Briglevics and Pecos type of estimation, demand estimation framework into financial intermediation. And so that, again, just this would fit very nicely into that. Obviously, that is a very different project, as would be any of these papers, but I think that would help you answer the development economics angle of your question much better. And yep, I think that's all I had to say. Thank you very much.
Well, thank you. Then it's time to open the floor for discussion. Are there any questions? Please.
Thank you. Fascinating paper and fascinating data. I had a couple of questions. First of all, I wasn't clear what your definition of long-term deposits was. How you distinguish long-term versus short-term deposits in your examination. I appreciate if you explained that. And secondly, for mobile payments, these agents also do pay out as well as pay in, because after all, that was what the remittances were, what these were for in the first place. So you need to get the money out as well as getting it in. Is that not the case for the bank agents? And if so, how does that affect the way we should think about what's here? And the third one is a political economy one. Why didn't they put the same kind of tax on the bank remittances?
Sorry, I didn't understand.
However they were taxing the mobile, couldn't they have done the same tax on the new bank system as well?
Okay, so I will answer this last question first. It was very fun to talk to the central bankers. So practically, what has been said is that the banking companies, the banks pushed a lot, hobbied a lot the government to introduce such tax. So this is the reason they expected this result. The banks expected this result. For the government, it was an easy way to get the money, and for banks, it was an easy way to boost the services. So this was a thing. As far as it concerns the withdrawals through banking agents, so yes, you're right. So technically, as for mobile money agents, you can withdraw money. So you can go to a banking agent and ask for your money back. Now, it's very hard for banking agents to be money managers. So for them, it's very easy to receive money and just tell the bank, look, this person provided this money to the bank, then to have cash with themselves and provide it back to people who ask for it. Because what they do usually is to go to the banks and store the money that they receive from people. So there is a method of money management there, which has some frictions. So I actually have data on withdrawals for banking agents. I see no results there. It's a practical, I mean, the numbers are 0 everywhere. So this is why I didn't produce, I didn't show any result, but yeah, you can technically withdraw money from banking agents. It's easier for mobile money agents because there is a very higher network, a huge number. We are talking about 100,000 mobile money agents all over the territory. It's very present. Mobile money agents deal with themselves to exchange. If we are 2 mobile money agents, you have mobile money and I have cash, I can tell you, give me some mobile money, I can give you some cash. So it's easier for them to exchange cash and to make money management. So for mobile money, it's easier to withdraw cash as well. And this is pretty much what happens. And sorry, the first question?
Long term or short term?
And about the long term, so this is a differentiation within the bank's balance sheet. So the bank's balance sheet already has demand deposits, cash deposits, interest deposits, long-term deposits. So it's a definition already provided by the banks to the central bank. So it wasn't me deciding arbitrarily how to divide the different type of deposits. So interest deposits are the one that bear interest. So they have a given time of amount that they need to be stored in the bank to produce some interest. So the banks categorize them as long-term deposits.
So there's another question.
Thanks. So really great paper and great presentation. I have two questions. So the first one is whether you look at real effects. I think it would make like the last mile of the analysis, the increasing credit might have an effect on, I don't know, production, employment, stuff like that. It was really kind of, complete the picture. And the second one is more like a conceptual question. So you mentioned that this is an example of an introduction on a new form of money, So you propose that narrative. I think there's also another one. So you explained that the mobile money providers were depositing the money at banks, right? But these are escrow accounts that the money had to be there. So you could interpret what happened is moving from a narrow banking system in which the money all have to be there to a fractional banking system where the depositors now withdraw the money from the mobile who have to be there 100% and deposit in a deposit account, and then the bank can just keep there some reserves, I don't know, 10, 15%, and the other 85% make credit. So from a conceptual perspective, it's not a new form of money, it's a different fractional banking system. And there's a lot of discussion about, the benefits of narrow banking. Should we move to a narrow banking? This is a great example of narrow banking. You lose credit and you lose money. Yeah, thanks.
Okay, can I answer? Or yeah.
Please.
On this last question, I completely agree with you. Honestly, also Professor Brunner-Meyer told me the same thing exactly. And you're right. I should frame it in this way. And it's exactly what's happening. So practically, I like the framework, because there is this escrow account, and the banks cannot really, for the regulation of a central bank, use this money in any way. They cannot invest it in any way, not even in government bonds. Now, since 2022, actually, they can, but in my setting, they could not. The money has to be there. The central bank needs, in any single moment, know how much money is there in the escrow account, because that money matches perfectly the amount of mobile money in circulation. So, but you're right. Next time I will try to rewrite the paper in this framing, because I think it's more interesting. You're completely right. As far as it concerns real outcomes, so yes, as far as it concerns the credit registry, I have the full information on the person or on the company who is getting the credit. I know everything about them, the sector, their employment, what they do, how much they earn. What I was trying to do, but it takes time, because every time I make a new request for data, we need to engage with a new agency. The central bank doesn't have all the data. So I wanted to match the data from the credit registry from the one with the ones with a social security system. And yeah, that would be a very great project. But this is the next step. We are working on it. It takes time, but I completely agree with you that to talk about financial inclusion and development is the next step to be done.
There's not enough time for one more question.
Thanks. I was wondering about the high ATM density places. Are these urban places, and are the low ATM density places rural places? And then if you could tell me also how big was the tax?
Yes. So practically, I need to say yes. There is high correlation between the presence of ATMs, both as density of the area, but both of the density of of a number of people. So if I can answer your question of the presentation, I see practically no difference by using the two kind of measures, by using number of ATMs by people or by area. So yes, there is high correlation between urbanity of a place and number of ATMs. So we can conclude that, yes, urban areas see a higher decrease in the usage of mobile money. And most of that higher deposits come from urban areas. As far as it concerns the tax is, you might say, just 1%. It's 1% on each transaction, which some might say is very low, especially if you compare it to the fees applied by the telecommunication company, which for some kind of transaction, especially the lowest one, can reach up to 30%. So like poorest people pay 30% to exchange money if they make very low transactions. But 1%, you might say, is low. But what happened right after the introduction of the tax? The media everywhere in Uganda started complaining about this. There was a very huge fuss about this tax. So some of you might say, so there is a behavioral matter. It's more a perception of the cost more than the actual cost. That's why I didn't know how to exploit it as elasticity. Because, you know, for higher changes in the fees of mobile money telecom companies, you don't see such a change in the usage, because those fees are practically hidden. I mean, you can find somewhere on the website of a mobile money company, or if you see how much money the other person received after you made a transaction, you can actually see, but people don't really see it. They don't hear the media talking about the fees of mobile. So this 1% tax was actually huge in terms of effect compared to the one that a change in the fees might have. I mean, I've seen fees over time changing of 20%, from 10 to 20% of the value of the transaction, and you practically see no change in how people transact.
Wonderful. Then thank you very much again.
Thanks to you.
And it is my pleasure to welcome the next speaker, which will be Alejandro Zamora-Pérez. Thanks. Transactional demand for central bank digital currency. The floor is all yours.
Oh. Thank you very much, Silvio. So I would like to start by thanking the organizers of this wonderful conference. I think it's going truly great. The dinner yesterday was lovely. And yeah, I also feel, I want to say that I feel fortunate that Scott is discussing the paper. I think we're going to get a lot of ideas from him to improve the paper. So yeah, as you see, yet another paper of CBDC. This one on transactional demand by my colleague Luca Nocciola from the European Central Bank also. And the usual disclaimer applies. This presentation should not be reported as representing the views of the European Central Bank. It's only our views. So I want to start the presentation with some real data on issuance on CBDC, just to anchor the discussion on real data. And this is what we see. We have very scant data, but at least it's valuable to start thinking about it and you know, as I say, anchoring the conversation on some real data. And you see that the proportion of CBDC issuance to cash issuance is less than 1% in all these jurisdictions, which there's data. I mean, all of them have rolled out in different ways CBDC. Less than 1% and less than 0.5% even. So, and when you compare this to the CBDC monetary base, it of course is going to be lower. And this sort of is being detected as a problem of policymakers may face in these jurisdictions, and also the IMF has just published a paper on this particular topic. So when you see the literature, the community has really worked a lot on this topic of pan disintermediation. So what would happen if CBDC is too popular? So what we call the problem of the too much problem, but not that much on the too little problem. So what would happen if we see this? And I wanted to start with this real data because perhaps it's something that we need to focus a little bit more about, and that's what we try to do with this approach. So some predictions of the literature. Jackie Lee, as you probably know, is a wonderful paper published in the Journal of Monetary Economics. She estimates that household liquid assets may shift to CBDC to up to 50%. It goes from 4% to 50%, and then she narrows it down with an extension of the model. But it can go up to 50%. Other papers estimate the optimal issuance at 15% to 45% of quarterly GDP. So there's sort of a contradiction, and we wanted to imagine why this might be happening. Also, in a completely different jurisdiction. Of course, this is not going to apply to the data to the countries that we are analyzing, but it's something nice to start with. So I want to start with the key results, and then I will explain a little bit how we get to these results. So the first key result that we see is the usage of CBDC at the point of sale. So this is only point of sale. We really see CBDC as a means of payment in this paper. Usage strongly depends on adoption levels. So you see in the x-axis, you have adoption rate from 0 to 1 to 100%, so universal adoption. You see that it's 0, of course, because 0 adoption leads to 0 usage, because it's conditional. And for universal adoption, it goes, our model estimates, we have a usage model based on survey data and based on some approaches that have been mentioned in the previous discussion. And we see that it goes up to, around 35%, so from 30 to 35%, depending on the design. So you have there 4 different designs. We are trying quite a lot more, but this is more or less where it gets. But the important thing is that depending on adoption, you're going to have different levels of usage. So this is one of the main messages that, we don't really know where the adoption is going to lie, and this is going to really affect usage and hence transactional demand. So all the papers that do not take adoption into account might be facing a problem of overestimation. That's more or less the comment. Which brings me to the second result that I want to present today, which is necessary to endogenously model adoption. And it's, of course, it's not an easy task because we don't have data for adoption of CBDC because CBDC is not there in most of jurisdictions. So we try to do that using one of the, I will talk a little bit more about it, but the approach was mentioned in the previous discussion. And you can see that, according to this particular estimation, aggregate CBDC adoption share is around 7%, and then you see the usage share is 2%, as seen in previous literature. Low levels of adoption lead to even lower usage. But this is, don't take this as fixed. It's really one of the specifications that we're using. The value of the model really is that we can try several options, and this is what we do. And the third result is, we want to also explain some of the drivers of adoption. They are not exhaustive, but we believe that is interesting also for policymakers to fine-tune how to get to different adoption and usage targets that they may have. And this is one potential strategy, which is combining the best features of traditional payment methods into CBDC design. So we have the best design and the worst design. So you see how it varies. Adoption changes quite a lot from 6% to 12%. And usage share goes to 2% to 6%. Also, we have data on how people changed their behaviors during the pandemic, so due to an exogenous shock. And one of the reasons they cite is because they discovered new means of payments. So this is pretty variable to analyze the role of information and awareness on new means of payments. And we use this in order to simulate what would be the effects of an effective information campaign. Using adoption, it increases a little bit less on usage. And then finally, we have data for 17 countries. So we can estimate whether the use of new means of payment, so in this case, mobile applications diffusions in the point of sale and in person-to-person payments, do have spillover effects on the adoption share of new means of payment. So in our case, CBDC. And we see that we only have this data, so you see the big confidence intervals are because we only have data in the 0 to 10% level, so that's why. So it's not, they are not widely adopted, but that's precisely what we want to show. A little bit more on the data. So our data is a space survey. It's a consumer payment survey. You probably know about it. It covers 40,000 individuals and over 100,000 transactions at the point of sale. It also includes online payments, but we are not focusing on those. It's collected over 2021 and 2022. As I say, covers several countries. And it's collected via a questionnaire and a one-day payment diary tracking transactions. So we also have a detailed attribute preference profile. So for the different attributes of traditional means of payments, transaction speed, privacy, safety, budgeting. You also have logistical convenience of cards. So where consumers prefer not to carry cards, and that's why they select the card. And also we have this information that I was talking about the changes in behaviors after the exogenous shock of the pandemic. So reasons why individuals changed their behavior due to the pandemic. So a little bit of an intuition on the usage model that we use. So this is assuming 100% adoption. So this was in the key result one. If you remember, it's going to be the right part of the chart. What we have is that consumers have J payment instruments in their wallet, so cash and cards, and they select probabilistically cash or cards at the point of sale, which generates utility U. The utility U is a function of these observable attributes that I was talking about that we can see in the survey. Also unobservable attributes, a random components, and then consumers choose probabilistically if the utility of one of the means of payments is greater than the other one. And we estimate the model using post-transaction data from the space survey. And then using these observable attributes, we are able to synthesize from the attributes that so we are basically using the approach of Lee. We take different attributes, different combinations of what we observe for cash and cards, and we create several designs of CBDC. This is how we do it. So it's a linear combination of attributes. We have this lambda parameter. So if we set lambda to 1, it behaves like card from the point of view of the consumers. And lambda equals 0 behaves like cash. And then we can fine-tune this lambda to see how the different attributes may vary and what is it affects in usage. So using the model estimates, we can calculate the utility that consumers derive from using CBDC at the point of sale and the market share of CBDC in terms of number of transactions. So this is one of the simulations, for example, setting lambda to 0.8. So it's a design that is going to resemble cards, but it's a hybrid. And you see, well, this is more or less what we can see from the simulations. It's just for illustrative purposes. And also, changing the lambda parameters for each of the different attributes, we can also assess what is the effect of making it more cash-like or more card-like, depending on the consumer preferences on usage. So there's this question on effective adoption problem, because, as you say, I mean, we don't know where the effective adoption is going to lie, but we believe that universal adoption, at least at the earliest stage of CBDC rollouts, is unrealistic. And after conditioning usage and adoption, you saw key result 1. That's what we see, a wide range of possible values of the adoption. And we believe that it's necessary to model adoption, as I was arguing before. And the thing is that it's necessary to find realistic proxies to model adoption. So it is unrealistic in our point of view to treat CBDC as a traditional means of payment because it's widely adopted already. So we don't believe that card ownership, for example, could be a good proxy. But perhaps it's also unrealistic to assume that app downloads may imply effective adoption. And this is also what we see in the data in actual CBDC rollouts. So our approach to proxy effective adoption is reported preferences for new means of payment methods, in our case, mobile payments, which is not too widely adopted in the Euro area countries that we are studying. So the literature observes a gap between reported preferences and usage, and Karin and Nicole have this nice paper, and Lola Hernandez, they have this nice paper explaining that preferences are really a first step towards usage. And we believe that preferences indeed show genuine readiness to use the means of payment. So that's really what we are interested in, so effective adoption. We model adoption following previous literature, so Scott and Kim are within the co-authors of these papers. It's a very nice framework that they use, and we thought that we could apply it for our case. So consumers face a choice of expanding the payment wallet, so what's effectively in their wallet, or what are they effectively intending to use at the point of sale. So it's not like you download the Klarna app or whatever and it doesn't work or whatever, you forget about it. We are trying to mimic what would happen if you actually intend to use that app. So then consumers choose a wallet B, conducting a cost-benefit analysis. They have expected utility, they have a cost, and the net utility is going to be defined as utility minus cost. And the adoption decision is going to be where the wallet, so the previous wallet, the bundle of instruments that they had before, has lower utility than the new one with the new means of payment. This is our proxy. We believe it's optimistic. Mobile payment technology is 20 years old, and we are taking all different apps. So we believe still is a strict proxy for adoption, but we still believe that it may be optimistic. But you know, it's also perfectly reasonable to argue that our proxy is too strict, and that's why we have this sensitivity analysis of the cost. So going from 0 to 1% of these mobile preferences. And well, you can calculate, for example, we have some results for where the cost is 50% of the proxy that we are using. So that's also, and it goes from 7% to 66% of adoption if the cost is 0. The drivers of adoption, as I said, in key result 3, it's not an exhaustive list, but we are focusing on habit flexibility, information discovery, and network effects. We believe that these are quite important. Also, our data supports this analysis. And yeah, so you see that adoption cost is going to be influenced by these different potential drivers. And just wrapping up, as we saw, it's a widely observed phenomenon. We have scanned data, we have scanned examples, but it's a widely observed phenomenon that low demand, there's a low demand for the rollout CBDCs. And usage seems to be dependent on adoption levels. It's necessary to learn where this adoption is going to lie, so it's not just something exogenous. So we need to model this part. The realistic process in order to do proxies in order to do this are necessary, and we are trying to model for these possible adoption costs, and they are influenced by different habits. And finally, there's some potentials to fine-tune CBDC adoption using the design, information campaigns, and exploiting network effects. So this is what central banks could do. And this is all. Thanks a lot.
Thank you very much. And the discussant is Schuh from the University of West Virginia.
Good morning. Thank you also to the organizers and all of you for this wonderful conference, third time in Austria, and this has been delightful as always. No one outdoes you. I wanted to just let you know that all the opinions in this discussion are mine. That's my old Fed impulse. But I also thought after Kim's presentation, I should declare that no AI was used in the production of this discussion. Okay, so things I liked about this paper a lot. First is it's an application of revealed preference theory. Last year at the Economics of Payments, there were a number of papers presented reporting results of surveys asking people what they would do about CBDC if it existed. I was uncomfortable with those papers, with all due respect to them. And this is completely different. This is taking what we've observed from behavior and trying to infer what might happen. I think that's a major step forward and to be congratulated. Given the assumptions, I think it's a very nicely executed paper. This use of the weighted average of the characteristics as a way of simulating what CBDC might be is simple and clever. But the clause, given assumptions, you'll see, I may have some reservations about some of those. That said, I think the assumptions and execution are very thought-provoking and are a major step forward in propelling us towards greater improving applications. And I don't often say this, but I have a double major in journalism and economics, and this paper is extremely well written. You should read it just to find out how badly we write in economics, because this is very, very clear and to be commended. Now, we got a problem, because Alejandro managed to finagle a seat across from my wife at dinner last night, and he charmed her, and she thought he was the greatest person on the face of the earth. Very kind, very nice. And we got back to the hotel room, and she said, in no uncertain terms, you will not say anything mean about Alejandro tomorrow. So that concludes my prepared remarks. But if you promise not to tell Susan, I'll show you the other slides. Okay, here's my assessment. He really is a nice guy, by the way. Here's my assessment of the author's conclusions. I see them as optimistic advocates, and the one thing I didn't really love about the introduction of the paper is that it came across as an advocacy piece that started off with the policy implications and then said, I'll show you how the paper works to get those policy implications. Usually we do the model and the data and show that the model fits the data and then say, well, if that's the case, here's what policy should do. And it sort of started off as, hey, if we optimally fine-tune payment instrument attributes, if we run a targeted information campaign, and if we maximize network effects, we could really boost the CBDC. So it's not, I didn't see the boosting of CBDC as really the goal of this research, rather than understanding how it might be high or low is important. And by the way, I was really kind of shocked at the information campaign, because since when does a sovereign government need an information campaign to get people to do things? I think CBDC will be forced upon us if the government and the central banks decide it, and the population will respond as they see fit. Now, here's my summary of the discussants, or my conclusions of the paper. And I'd say I'm still a healthy skeptic. The adoption and use rates are really low. It's about 7.5% adoption, use to 2.6%, assuming that it's going to be like a mobile app, which we'll talk about. The optimal instrument characteristic effects are not large. They're 2 to 4 percentage points depending on where they were. He showed you a graph. So if there's more anonymity or less anonymity, makes a little difference, but not a lot. And using those optimal characteristics, you might get adoption up to 12% or use up to 6%. These are not large numbers. The adoption cost effect, of course, is huge, but that's kind of almost by definition. Of course, if it's a high adoption cost, people aren't going to do it. And when the cost goes to zero, we get huge numbers, but the cost is never going to be at zero, so I'm not sure that's very plausible. And the information campaign effect is really quite modest. So the question is, are these basic results plausible? And I think if you're an advocate, they're way too low. They should be much higher. And if you're a skeptic, you might even think they're too high. So everyone will have their own view of that. Now, there's a few hiccups in my mind that I'm going to go fast, starting out of the starting gate, that relate to this a little bit too much of an advocacy leaning for me. Cash is currently the only form of public money available to consumers. No, demand deposit accounts are also. What potential dangers emerge from weakened demand for cash/central bank money? Seems to conflate government and social welfare. Improving domestic payment efficiency and safety are the primary motivations for issuing a retail CBDC. I don't doubt that that's the stated effect, but I think there may be unstated reasons, like getting rid of private domestic currency, digital currency. And the importance of stability, financial stability and monetary policy as a motivating factor has declined over time. Seems, on the face of it, implausible. But here's the one I have to remark on as a macroeconomist who specialized in monetary policy. One of the main motivations to introduce the CBDC is to preserve money as the anchor of a monetary system. Well, in the US, we had a great inflation in the 70s, and then we had a pretty good inflation in the early 2020s, and so I'm not sure we're doing a great job of preserving that in the first place. Model assessment. So I think this random utility setup, because it's very closely related to work I've done, it's, I think, generally standard and unobjectionable, maybe even excellent. But I think the key thing that I would point out is that adoption and use should be simultaneously determined. It's not that use depends on adoption, it's that adoption depends on future use. Because if you think about a present value model of these decisions, the only reason an agent would adopt is if the present value of future utility from the use, it makes sense. And so, two-step approaches in the old days always had a selection effect in the use model that I didn't see in the regressions here. And the one-step dynamic approach, which I think is superior, which he mentioned but was not cited in the paper, and I couldn't tell whether they actually used this model or not, but it has many elements of KRSS, but I would go all the way and do that. I want to take 1 second to just push us a little bit farther to where I've gone since I left the Fed, which is to try to bring payments into a broader economic framework. The random utility the models that we estimate of payment choice are really about the relative costs of payment choices. They're not about the value of payment methods on overall utility from consumption. And I think those relative costs of payment methods are much smaller than the value of payments to various consumption outcomes and overall utility. So in a paper that finally got published after 8 years, Scott Fulford and I have input an endogenous payment decision into a lifecycle consumption model and showed how that matters. But the first step to the decision is not the instrument choice, it's the asset and liability choices that are part of the budget constraint. And I think we need to model those first and the payment choice second to really get a full understanding of how this works. Now, why does this matter? Well, obviously the optimal consumption saving path depends on whether we're using assets or liabilities to pay for things. Liquidity effects are really important. Tamás and I found that there's no correlation between cash use and the price of the payment when you condition on availability of cash in the wallet. If people have enough cash in the wallet, they're probably using cash as constant. And debit card is not equal to a credit card, and they seem to combine in the paper. Cards, those need to be separated because they're assets and liabilities. They're very, very different. And Scott and I found a very interesting thing. Even within credit card use, revolvers who carry credit card debt have a much smaller percentage of credit card use than people who don't. So even within a class of payment instruments, there's variation that we're missing by just focusing on cash versus credit. Now, I think the model could use a little bit more infusion of monetary theory. Accounts are not instruments. I think we need to adopt the accounts, model the adoption of the accounts first. And cash is not money. Sometimes the paper makes statements about cashless as where it's not moneyless. In the old days, we paid money, or we paid for things out of transaction balances, which was M1. Today, we have a whole range of things, including payments directly from liabilities, like a credit card or even a home equity loan. We can make payments out of private digital currency and eventually central bank digital currency. So we need to model this monetary foundation first. And I think the one thing that is really challenging for this whole idea is a debit card based on fiat money the same as a debit card based on CBDC? The characteristics of the debit card, I think, in most payment analysis would be identical, but they're not identical payments because the fiat money and the CBDC have different properties, and that has to be modeled. Okay, as I said, I like the author's simple application of this, but is the mobile network really the right thing to link to CBDC? I'm not sure, but I think given the assumptions and the approach that they've taken, it's an interesting framework that I would rethink a little bit. And the way I would rethink about it is mobile payments is a network. It's not a payment method. It's not a money. And CBDC is distinctly different. So mobile payments are not money. The apps are not payment instruments, but they use payment instruments. There's a physical network versus electronic network. There's direct contact for the consumer, and there's hidden contact with the consumers. There's differences between these two things that I think limit the ability to use the mobile as an example. And the one I like is iPhones, iPads, and MacBooks are all mobile payments. They're not really mobile payments. They allow you to make payments mobily if you have an air card in them. And so we need to think carefully about separating the technology from the money theory. And lastly, I wasn't sure why they didn't use the adoption of PDC to better understand the adoption of CBDC. From work I've done, on the left-hand panel, you can see that it just takes a really long time for knowledge about the technology to emerge, right? So from 2008 to 2020, it took a long time, but eventually people will become aware that the technology exists even before they decide to adopt. Well, adoption of Bitcoin has been gradually rising slowly as the awareness of it has occurred. The intensive margin of ownership has been pretty flat. But here's what's interesting is for the PDCs, which are different because they have this expected appreciation component, even though the adoption of it has been increasing, the use of it as a payment method has been declining, even though for those who are using it as a payment method, the number of payments they're making is increasing. So, final thought is, we assume payments are invariably linked with their money, that you have to use Bitcoin on the Bitcoin network. But a paper I discussed earlier this year was really eye-opening to me, and it basically showed that consumers transfer money from their PDC accounts, Bitcoin, into their demand deposit accounts, and then they pay with them. So they're using this other money as a store of value, and then they're moving it to the fiat money to make the payment. This is phenomenal. This is another great Scott Baker paper. And I just wonder, would the same happen with CBDC? Now, for Susan's sake, given the assumptions, very nicely executed. Assumptions and execution are very thought-provoking, and Alejandro is a really nice guy.
Thank you. Yeah, thank you very much. I'm opening the floor now for questions. So, please.
Thank you very much, Alejandro, for a really great, insightful view into this, and thank you, Scott, for your response as well. So, Alejandro, I wanted to ask you about some of what Scott presented. Actually, when Scott had said in a few cases that actually users have many kinds of money at their disposal, and cash is not the same as money, and we shouldn't combine debit and credit cards because they're very different economically. And we should separate technology from the money in the case of mobile payments. I wanted to ask you what you think about the perhaps operational or maybe non-economic properties of money that might be relevant to this conversation that you might be trying to grasp. I mean, after all, if we look at it just in purely economic terms, a receivable is an asset and might as well just be the same as cash, and we would hold it on our balance sheet the same way. Mm-hmm. But functionally, it's very different and might be relevant in the event that we go bust or have a liquidity problem. So I wanted to ask you whether there are operational considerations that you think are really driving this research, and whether you think that there's a way to characterize that in the context of this economic frame. Thanks.
Very good question. I think we focus mainly on the means of payment part of this, and it's quite difficult, I believe, in this setting to characterize it, all these operational considerations. I think it's, I do agree with Scott, but I don't know, I cannot think of any way using these sort of models that we can characterize this, unless, of course, that we have substantial change of the model. But yeah, we will have to think about it. Yeah.
Okay. More question?
Thank you for a great paper and great presentation and great discussion. My question is about two-sidedness. So, you know, the CBDC or other payment instrument, or a two-sided market. So when you estimate this adoption and usage, where the adoption, the other side, like merchant, acceptance is included?
Yeah, good question. I didn't focus on merchant acceptance. We do condition the model of merchant acceptance, but we don't endogenize the dynamics of the two-sided markets because we don't have data on merchants. But yeah, we could try to use another survey that we have on merchants and try to make an extension and endogenize the part. What we do for CBDC, we are assuming that always that a card is accepted, CBDC will be accepted. So we basically are constraining the model to that. And yeah, we have real acceptance rates from the survey, so we can include this real data too. But yeah, the dynamics are not, and the two-sided market dynamics are not included.
Okay, Adam Głogowski, Central Bank of Poland. Thank you for the presentation, the paper, and also for the discussion. So I have first a question to Alejandro. To what extent do you think that this framework could be used to answer the question? Basically, what are the factors that are the most important for the low usage rate of those CBDCs that have already been launched or are that are out there in the wild? So, do you have any reflections on which aspects of those CBDCs are the most important from the point of view of your framework? And the second is actually a comment to the discussion. So I would be very hesitant to use Bitcoin adoption as a proxy or as a source of information, in the sense that it's a much more volatile asset than any CBDC could plausibly be. In the sense of the volatility of its market value. So I'm not sure that this would. I mean, it's in the broader sense of adopting new technologies. Okay, but I'm hesitant to think of the adoption of Bitcoin with all the uncertainties regarding the quality of the data on how many people actually use Bitcoin to model this sort of questions. And I would even frame your observation. I mean, it's maybe just on the timing. I wouldn't say they convert another form of money. They exit an investment. That's how I see the Bitcoin market. Thank you.
Okay, so the first question, how to apply this framework to the existing CBDC rollouts and why the issuance is so low. So what we see is that adoption really depends on issuance. So effective adoption, we see in these cases, we see quite a lot of downloads at the beginning. So there's a hype, there's people trying the app. They're mostly app-like CBDCs. And then what we don't really see is a lot of transactions or the issuance is quite low. So it might be that effective adoption is not really there. It might be that in these jurisdictions, the cost of adopting new means of payments is really high. They already have very strange habits. You see that they come from very certain jurisdictions. Perhaps they have a number of characteristics that lead to a higher adoption cost for this kind of thing. So that's what I can think. And according to the drivers, habit flexibility. CBDC, central banks are actually doing a big effort in trying to make people aware about this, but it still hasn't picked up. But also, you have to think that these are only the first years. So as Scott was explaining for Bitcoin, at the beginning it was not adopted, and after several years you can see adopted now. There's a paper being revised in the American Economic Review on dinero electrónico in Costa Rica, which is a nice example. So you have that it was launched, I believe, in 2014, and until 2016 it didn't pick up. So it may be that we're in this stage that people are starting to know about this new means of payment, and it takes time for networks to operate and make the CBDCs to pick up. So it might be just that we're in a very too early state. So that's a possibility.
Perfect, and we're well in time, and thanks again to... Sorry, you wanted to add?
I think, well, if we have time, he wanted me to end. I can tell it later.
Okay. Then it's time to move to our next speaker. Thanks again to the presenters. And I welcome Xiaoying Li from Kelley School of Business at Indiana University to present to us a paper called Central Bank Digital Currency Effects on Deposit Competition and Funding Stability.
Thank you very much for having me here today. I'd like first to extend my sincere thanks for the organizing committee for the invitation and the opportunities to be able to present my job market paper here today with you. So the paper entitled Bank Works with Central Bank Digital Currency, Effects on Deposit Competition and Stability. As the title suggests, this paper will be using observational data and to provide, I think it's very first few empirical results, how the deposit demand for the deposits changes after the shock of CBDC, and also how the bank actually respond to the different to the changes in the deposit demand, and consequently, what is the implications for the bank stability. So before I dive into details of my paper, I'd like to first talk about some of the new development of the retail CBDC around the world. So I just read the news on my flight to Vienna. The Bank of Canada actually announced on Tuesday that it will shift away its work on the retail CBDC. So it claims that there is not a compelling case for retail CBDC. And usually when people talking about CBDC, one of the drawbacks is that there is clearly lack of clear usage case for retail CBDC. Why is that? Like central banks could push for the adoption of retail CBDC. However, as we all know that, the actual demand from the consumers and businesses is actually very low. And I think one of the critical reasons, and this probably could answer one of the questions from the previous discussion, is that why people are not use CBDC for their transactional purposes is because in most jurisdictions, in most countries, there is already very advanced payment systems existing here, and people are customers are used to use those existing payment systems, so there is no urge for people to use a new, like a redundant, a new payment platform, which is a retail CBDC. And give you, for example, here, at least like FedNow, which is an instant payment system offered by the Federal Reserve. So one of the most features that people are thinking about the benefit of a retail CBDC is that it offers a instant clearance and instant settlement. But this benefit could also be achieved by using instant payment systems. So we really don't need a retail CBDC to achieve that goal, right? And to give you a concrete example, I collect actual data using the Chinese data. So here I collect daily app usage activities from the whole period of the 2022. So what I have here, so one data record is one click of potential consumers click the app on their mobile phone. So we can kind of, I think this is the most close proxy for the actual usages of the potential consumers using the CBDC. So whenever they click one time on their app of the ECNY, which is a Chinese retail CBDC, there is a one data record for the user activity data. So the left y-axis is the ECNY usage data, and the left y-axis is the Alipay usage data, which is one of the two dominant third-party payment systems in Chinese market. So we can see from this whole period, and I take the average of the daily data to have the monthly data, from January to December of the 2022, which is 3 years after the initial introduction issuance of ECNY in Chinese market, we see that on average, approximately the ECNY activity user data is 100 times less than Alipay user data. So we see clearly from this figure that Chinese consumers are not using ECNY for their daily transactional payment purposes. But there is another very interesting data, is that, okay. If we look at the total population coverage, like a total adoption rate, it's not small. And there is a total of 130 million ECNY wallet have already been opened by individuals. So one wallet represents one individual here. So in terms of the total population, that is 10% of the total Chinese population. And you may think that it's still small, but realize the fact that ECNY is not nationwide adopted. Like only couple of cities are allowed to use ECNY. So given that very few regions people can use ECNY, the 10%, I think it's not a trivial number, it's kind of large. So there seems to be a contrary, from the previous paper, I think. So the adoption rate is not low, but the usage is very low. So why is that the case? To answer that question, why people register for ECNY, why people open ECNY, but they don't use for their transactional purposes? To answer that question, I think some of the institutional details of the Chinese market are warranted here. So to use ECNY, individuals can download the app on their wallet, on their mobile phone, and then they can choose to link the ECNY wallet to one of their bank deposits. And this is a very critical feature and very valuable feature for individuals, because by linking their ECNY wallet to their bank deposit wallet, they can immediately transfer their money from their ECNY account to their bank account. And I think this is especially very valuable feature for those depositors of smaller and riskier bank. Why is that the case? So think about, especially for the crisis time period, if you want to, if you think your bank will become insolvent or bankrupt, you have actually, I think, two choices. You can either withdraw cash, or you can transfer your money from this small bank to maybe probably a larger, safer bank. But if you want to withdraw cash, we know like small bank, they in general have very low presence, like they have a very small number of branches, and most of their branches are concentrated in the local area. So if you travel to a different city, like me, I travel abroad, then I cannot transfer my money. I cannot, if I want cash, I cannot withdraw cash from my bank account because there's no branches. But you can use a different bank branches or ATM, but then it will cost you extra fees. Therefore, for smaller depositors of small bank, it's not flexible for those people to access cash if they suspect that there are some problems of their bank will go bankrupt or insolvent. Therefore, another way is that they can transfer between bank accounts, right? But remember, to maintain multiple bank accounts for one individual is costly. Like in US, you have to pay a maintenance fee, or you have to keep a minimal balances in the bank account to make your bank active. So in order to transfer, and also the processing time is not instant. It takes time depending on what kind of method you want to use. Like you can, this is an example from the ICBC, one of the famous bank in the Chinese market. So it actually will cost you, sometimes it's within half hour, but sometimes will be within like 2 hours or next day, depending on its working day or next working day, or depending on its ATM or online banking, mobile banking. But if you use the feature, like I mentioned previously, this linking feature, you transfer money out immediately from your bank account to CBDC. And if you want, you can also transfer again from the CBDC account to another bank account. That is instantly transferred and without any costs. Therefore, we see that CBDC actually offer a more flexible way for people, for consumers to move their money around, which is could be settled instantly and seamlessly and without any extra costs. Because of this mechanism, the smaller banks and riskier banks actually becomes more competitive in that sense, because consumers do not need to rely on large banks offer their deposit services, because they can quickly and seamlessly transfer the money between banks. So in that sense, and also the prediction would be like the small bank, we would observe increases in the market share, and the deposit will move from large bank to small bank. And consequently, the rates for small bank relative to large bank will decrease. And this is the same prediction from one of the paper by the Garand, Yu, and Zhu, although they offer a different mechanism. But this is not the whole story of my paper. So the mechanism is actually richer than that. We know that although it makes the small bank more competitive, they can attract more deposits and a lower cost. However, exactly because of the feature that people can seamlessly withdraw their money out, it actually increases the background risks of smaller bank. So on the one hand, the ECNY enables small bank to attract more deposits, but those deposits are more flightier. And those flightier deposits inflows could take the form of hot money, and they could quickly change their cost when, especially during the crisis times. So this is kind of the similar mechanism like in the JF paper by the Goldstein and Posner. They say that the bank cannot increase liquidity provision without increase the background risks. This is actually what we see here. The small banks enjoying, on one hand, enjoying the increases of the liquidity inflow of liquid deposits, but at the same time also increases their cost of background risks. So under this mechanism, what the bank will do, what they respond to this flightier deposit base, I will show in my later empirical setting. Actually, smaller banks, they increase the long-term deposit rate. And so this is a supply set of effect. Because of that, they shift their deposit structure towards more longer maturity products. And in that, consequently, it will make their funding source more stable, because long-term deposits are more stickier than short-term deposits. Okay, so I want to skip some of the literatures and my reviews and jump to the empirical setting. So the reason I use the Chinese market is because not only because it is the largest scale of the CBDC rollout in terms of total population adoption and also in terms of total transaction volumes. Usage of the CBDC, but also because the CBDC, which is introduced by the Central Bank of China, it implemented that in a lateral experiment, which I can explore the variations, random variations. So I used 3 waves of shocks. The first shock is back in the November 2019. There are 5 cities joined the CBDC program, and later on, 1 year later, there are additional 6 cities. And the third wave is the March of 2022. There are another additional 30 cities joining the ECN program. So basically, different branches located in different cities, they exposed to the ECNY shock at different time. So I explored the variations of those different bank branches in different cities to the ECNY shock. And this gives me a very natural setting for the triple difference in difference. So here, equation 1 is my specification here. The first difference comes from the the changes of the outcome of interest. Here is the deposits and the deposit rate following the shock of the ECNY. And the second differences captures the is the city level, like if the bank branches will be located in, depending on where they're located in cities where the CBDs are available. And the third difference is, which is the core focus of this paper, is the differential effect between large and small bank. And also I use different proxies for the classification of small and large bank. And the first one I will use like the assets. If a bank is small, it means that the assets is less than the median of all the banks in the beginning of a sample. And another, I will follow the literature using the bank deposit, the deposit beta. So the results. First of all, the checking rate. So as confirms the prediction for all the short-term rates checking, 3 months and 6 months rates, we see that small banks actually decreasing those short-term categories of deposit rates relative to large bank, and the magnitude is kind of significant. So for the checking rate, the largest number is 9 basis point in column 3. And the magnitude is even larger for 3 months rate and 6 months rate. It's around like 100 basis point for 3 months, and this is even bigger. And across all of the specification, I use different fixed effect. Like column 1 and 4 is the city and bank quarter, and the column 3 and 5 is the quarter and bank city. And the most restrictive fixed effect specification is column 3 and 6. I use the bank city and the bank quarter fixed effect. Then if we move to the longer term deposit categories, we see that for 2-year rates, 3-year rates, and 5-year rates, small bank increase those long-term rates relative to large bank. And what about the quantities? Here, the dependent variable is short-term deposits relative to long-term deposits, quantities. We see that by small banks, because of the adjusting the deposit contracts differently over short-term and long-term deposit categories, the ratio of those short-term versus the long-term rates of the quantities actually decreases for smaller bank, meaning that smaller banks are shifting their deposit structures into more longer maturity categories of the deposits. And I think this is interesting, and I think this is have important stability implications as a result of those results, because we see that the CBDC changes the behaviors of the consumers, whether they choose to put their money in. They can now more willing to put their money in smaller, riskier bank. And also the small banks increases long-term deposit rates. So the shifting from short-term deposit quantity to long-term deposit quantity makes the funding base for small banks more stable, making them more resilient to the sudden withdrawal of deposits. Okay, so the identification assumption for a triple difference is that of a parallel trend. So here I graph the dynamic difference in different shock period, and we see for both quantity and checking rate and 3-month rate, the pre-trend is parallel, meaning that it is indeed the shock of ECNY causes the changes in the demand behavior and the changes of how bank responds by adjusting their deposit contracts. Okay, and the remaining paper, I will do some robustness testing. Instead of using the 15th percentile, I'm using the 75th percentile and also 95th percentile. And also I'm using a different classification of the bank category. Here I'm using the deposit rate, deposit beta. And I find similar results for both checking 3 months and 6 month deposit rates. Okay. So that's a summary of the main results of the paper. So in this paper, I find out ECNY actually changes the term structures of deposits in the sense that small banks reduce their short-term deposit rates. However, to offset the risks of the bank runs, they also raise the long-term deposit rates to lock in more stable fundings that would have been subject to the sudden withdrawals. And also, ECNY changes the deposit compositions of different banks. So small banks shift their deposit composition toward longer maturities horizons. So by increasing long-term deposits, they reduced their reliance on those flightier short-term funds, which are more prone to withdrawals. So that's the end of my presentation, and I'm very much looking forward to the discussion and questions. Thank you.
Thank you so much. As a discussant, we have Daisuke Ikeda from Bank of Japan.
All right. Thank you very much for having me. Again, my name is Daisuke Ikeda, the Bank of Japan. This is my first time to be at Australian National Bank and first time participating in the Economics of Payments conference, so very excited. Before starting my discussion, typical disclaimer applies. This discussion, the views expressed here are mine. Okay. So Shaolin explained her paper very well. But let me start with just one-page summary of her paper. So I think the elephant in the room, so in this conference, is what are the effects of introducing CBDC on banks, or payments, or the real economy? And this paper focuses on the effects of introducing a CBDC on banks. And according to the theoretical literature, there are mainly two predictions. The first prediction about the impact of introducing CBDC is that it would improve payment efficiency and would reduce transaction costs if CBDC provides better technology and better convenience. And so that's the first prediction. And second prediction is that introducing CBDC may raise bank run risks because by definition, CBDC is 100% safe. So if depositors have concerns over the safety of banks, and if technology allows to transfer deposits from banks to CBDC instantaneously and without limit, then that could raise bank run risk. And so these are theoretical predictions, but there is a challenge. CBDC hasn't been introduced in many jurisdictions, so lack of data. So addressing this question, what are the effects empirically has been challenging. But Sharin's paper tackles these questions, overcomes this challenge by focusing on the People's Bank of China's introduction of ECNY. So as she explained, this is the pilot program. And 4 cities participated in 2020 or 2019, and additional 5 cities in November the same year, and additional cities in April 2022. And she has collected bank branch level data on deposit interest rates and deposit composition. And her paper takes advantage of variations across timing of the introduction of CBDC, and variations across city, and variation among banks, and to estimate the effects of introducing a CBDC on banks. The main findings are threefold. The first, small banks decreased short-term deposit rates. So as she explained, the small banks with CBDC, small banks are able to link their services with services provided by CBDC, and small banks are now able to provide better payment methods. And so the result that small banks decrease short-term deposit rates is consistent with prediction 1. And the second and third results are that small banks increased long-term deposit rates and also increased the share of long-term deposits. So one interpretation of these results is that so there is a perception, a fear of perception by small banks that this may raise the risk, bank run risk, and so small banks would want its funding base to be more stable, to make it more sticky, and so increase long-term interest rates to attract long-term deposits, stable funding, and so that's what small banks did. And so this bank behavior is consistent with prediction 2. So overall, my take is it is very interesting paper. I'm not familiar with the universe of empirical studies on CBDC, but presumably this would be the first empirical work on the effects of a CBDC on bank behavior. And this paper confirms theoretical predictions 1 and 2. And I'm sure that this will stimulate further empirical works and also policy discussions. But as a discussant, I need to play a role. And so, although I'm not very much familiar with this line of literature, but as a macroeconomist, I'd like to make a few comments. Okay. So before that, let me just recap her empirical specifications. So left-hand side, independent variables are deposit asset ratios by duration, long-term deposits or short-term deposits, or deposit interest rate, short-term and long-term. And on the right-hand side, there is a CBDC dummy, depending on city and timing, and also large bank or small bank dummy, and also this specification controls bank, city, or time fixed effects, and focuses on the coefficient beta 1, the impact of introducing CBDC on banks' behavior, the composition of deposits, or interest rates. Okay. So my first comment is that this pilot program started 2019 or 2020 coincided with, I would say, the bigger event, that is the COVID-19 pandemic. And in response, there were forceful policy actions that could have different effects among cities. And for example, according to the IMF, following the early 2020 lockdown, the economy embarked on a V-shaped recovery and estimated 4.9 trillion RMB, equivalent to 4.7% of GDP of discretionary fiscal measures. And the PBC provided monetary support, liquidity injection into the banking system, and also targeted reserve requirement ratio cuts, depending on the size of banks. And also, the government and the central bank encouraged lending to SMEs. So in my views, the impact of the pandemic itself, and in response, lockdown, the policy measures, and targeted measures, these have, different effects among cities and banks, depending on its size, and over time. And so I think, by coincidence, the pilot program, conducted by the PBOC, coincided with this, the huge impact of pandemic and policy responses. And so the effects of the pandemic and policy measures need to be taken into account. So for example, this figure plots the reserve requirement ratios for different banks with different size. So looking at the purple line, in the beginning of 2020, the reserve requirement ratio was cut a small amount, but kept flat. But looking at the mid-sized banks, pink line, or small banks, green line, there are additional cuts in reserve requirement ratios. So this would have different impacts on the banks with different size, and could have different responses, setting deposit interest rates by banks with different size. Okay, so my second comment is the implication of limited usage of ECNY. So there were many, wallets that were held by the population, 10% or 18% of the total population. But looking at the actual usage, the ECNY only accounted for 0.13% of the M0 money supply, according to her paper. So the paper admits that the additional convenience provided by ECNY should be limited. And so the driving force why the small banks decreased short-term interest rate is largely due to the safety channel. So small banks are able to attract more deposits, and so could decrease short-term deposit interest rates. But I wonder whether this interpretation is consistent with prediction 2, increase in bank run risk, or actually does the option to switch from deposits to ECNY make the banks safer? And so I think this is not about the empirical result, but the interpretation of the empirical results. And my third comment is very simple. So I wonder whether there are branch level or city level variations in deposit interest rates within the same bank. So for example, in Japan or I think in other countries in Europe, I think branches in different locations basically offer the same interest rate if we look at the same bank. So in Japan, if there is a bank which has branches in Tokyo and Osaka, I think they would offer the same deposit interest rate. Internet banking is available, so if they offer different deposit interest rates, there would be arbitrage. My related but a bit different comment is about this figure. This figure plots the beta 1 coefficient, the effects of ECNY on deposit interest rates. short-term deposit interest rates, and x-axis is the percentile of size distribution, so from the biggest size to the smallest size. So this figure clearly shows that large banks increased deposit interest rates, and smaller banks cut the short-term deposit interest rates. But I see this continuity at 50 percentile. So this figure makes me wonder whether there are other factors affecting why smaller banks responded differently. So I have other very small comments, but I'm very interested in the distribution of type 1 to type 4 wallets. Especially the type 1 wallet has no restriction on the usage or holdings of the ECNY. And so I want to know if you have data. I want to know the distribution of type 1 to 4 wallets. And also, so you focus on the different responses of banks depending on size, small and large banks. But I wonder if there is any different behavior within the same type of banks. If you just focus on large banks or small banks, are there any different behavior depending on the introduction of CBDC in different cities? And so I didn't have time to discuss about the model, but looking at the paper, there is a model section. And so I think hopefully, tighter connection to empirical analysis would help. Overall, very interesting paper, and I think this would invite further interesting questions and more works. Thank you.
Thank you very much. Then I'd briefly open the floor for a few questions. Over here. Please.
Hey, I'm just wondering if you looked at or tried to look at effects that this might have had on banks lending, like if deposits are more flighty, they might be willing to lend less, which is, I think, a question on a lot of people's minds about the effects of a CBDC.
I didn't have a chance to present here, but in the paper there is a section about how the differential effect of the CBDC on the lending behavior of different banks. So actually I found out because of the deposits increases for small banks are actually able to extend more credit in terms of loans to businesses. So yeah, I hope that helps.
Thank you. Thank you for the presentation. It's really very interesting. I particularly was interested in the fact that you found a really useful use case for the electronic monies in China, where there's always been cynicism about whether there was such a thing. Mm-hmm. And in fact, that cynicism often said that the reason that these were adopted at all was the bonuses that you could get by holding them in the first place, and that this was simply the adoption was simply an opportunity to get that money, drain it out, and use it on their own. The fact that you find something seems to belie that cynical interpretation. But it would be nice to know if you can find your explanation in there more concretely. So is it the case that you can get more information about actual transfers with ECNY to see whether or not your explanation as to why it's being used is actually showing up there? And one way you might want to think about doing that is, are there examples of small banks in trouble where you can see increases in the flows as a result of it?
Yes, thank you for the question. These questions are also asked by one of the advisors. Actually, I'm doing a survey.
Professors all think alike, yes.
Yeah, actually taking a survey like in different banks right now, in two banks. I want to know consumers whether or not they are actually thinking the mechanism I'm discussing is the underlying mechanism they have in their mind. Right. So I haven't yet finished the survey, But I will update you when I have the results to see whether or not this actually in the mind of those consumers, like I discussed in the paper. And the second question, I would like to have that kind of luxury of data, but I don't think I have access to this detailed transfer data from different banks to yeah.
But then you might still want to be able to use what you do have to to compare timings of whether or not problems in a particular bank have caused jumps in the amounts of.
Right, exactly. Maybe I can use a different shock, like when there are specific negative shocks to certain types of bank, but not to another bank, and to see what is the differential effect. Yeah, thanks.
So there was one last question here in the back. Yes.
Is that on? Okay. Maximilian Gammon from the European Central Bank. So thank you very much for these intriguing insights into CBDC, which for me has always been a bit of a black box. And apologies if my question doesn't really relate to your paper, but more maybe to your intel on this CBDC. So you said, or showed that the usage of the ECNY is not great if you compare it to Alipay, for example, but has the mere existence of the ECNY, and I don't know about the pricing or the pricing in general of payments methods in China, has that led to a change in the pricing overall in the market?
You mean other different payments?
Yes, of different payments, basically as a kind of additional competition, as an additional option offered by the PBOC.
Yeah, so the competition of CBDC with other existing payment systems, I think is limited. Because people are not using CBDC for transactional purposes. So other the payment system like Alipay and WeChat or back transfer, although I have no direct data and empirical evidence to show you today, but I think there is no direct effect of ECNY on the pricing of the other payment method. Yeah, but I will look into more details about that. Thanks for the question.
Okay. Thank you all very much. With that, I think we are ready to close the session and head for the coffee break. And thanks a lot to all the speakers and discussants and for all the questions that we've had here. Thank you.
Dear colleagues, welcome back after the coffee break. And before I introduce our keynote speaker, Piero Cipollone, let me use the opportunity here to make a very brief announcement concerning the future of the Economics of Payments conference, because this is the 13th conference now here in Vienna, and the conference exists since 2004. And initially we were running on a 2-year cycle, and then in more recent year increasing the frequency to annual cycles, and it is a good custom to use the ongoing conference to announce future locations so you can plan your research and your paper submissions. So as concerning 2025, next year, we are still uncertain whether a conference will take place. We try to organize an event, but we have not yet found an institutional partner to commit to host the event. But for 2026, we have found a generous partner that is able to host it, and I would like to give the floor briefly to Daisuke to announce the 2026 conference invitation.
Thank you, Martin. So I'm from, again, the Bank of Japan Institute for Monetary and Economic Studies. So we are very much interested in holding the Economics of Payments conference in 2026. And so that will be the first time in Japan and the first time in Asia. So after more than 20 years since the launch of this great conference. And so I hope I will be able to see many of you in Tokyo in 2026. So details and exact dates to be determined, but I will keep you updated. Thank you.
So I have now the honor to introduce today's keynote speaker, Piero Cipollone. Piero is a member of the ECB's executive board, and he is the chair of the Eurosystem's high-level task force on the digital euro since 2023. The task force took up its work in 2020, initially under the chair of Fabio Panetta, and Piero took over from Fabio in 2023. And in this function, he is addressing our conference today, and we are very happy to have this opportunity, and we are extremely grateful that you took the time to come in person, which is not taken for granted nowadays, to address personally this audience in a keynote and tell us what's going on in the work on the Digital Euro project. Piero has an illustrious career in both public service and academia with a focus on economic policy and financial systems, which is the core of his expertise. He holds degrees in economics from Stanford University and from the University of Rome's La Sapienza. His distinguished career spans several senior roles, including Deputy Governor of the Banca d'Italia, Economic Advisor to the Italian Prime Minister, and Executive Director in the World Bank Group, among many other distinct roles. In his current role, Piero chairs several key committees, including the Eurosystem High-Level Task Force on the Digital Euro I mentioned before, and the Euro Retails Payments Board, and he's guiding in these roles pivotal initiatives shaping the future of European payments and digital finance. So we are very honored, Piero, that you came to us today to address this conference. Please join me in welcoming Piero Cipollone. I should say that Piero is happy to accept a public discussion after his keynote speech, and we are looking very much forward to that as well. Thank you.
Thank you, Martin, for these nice words. Good morning to everyone. It's a real pleasure to be here, participate to this very important conference. The quality of the papers we saw this morning testify the quality of this conference and why it was worthwhile to come here. Unfortunately, I couldn't be with you in the previous days because I had another engagement with the part of the complex European structure of making decision. It's called EWG, which is a technical working group behind the Eurogroup. So I went to discuss with them the important topics of digital euro. So it's a continuous effort to explain people what we are doing. So I am really, really happy to be here. I think before I go to the formal part of my speech, I think we need to understand some key specificity of the euro area. When we talk about CBDC, and I see this paper, they are very interesting, they're deep, they allow us to understand the deep linkages. But there is something missing, which is the reality we start from in the euro system. In my speech today, I will try to convince you that there is some specific characteristics of the euro system, of the euro area payment system we have been trying to solve for 25 years with different attempts, and we are still struggling. We think that the digitalization of the economy offers us an opportunity to jump ahead and try to finally solve this problem that, as far as I know, no other jurisdiction of monetary union has. So let me try to go to my speech. It's kind of long. It's about 35 minutes, so please bear with me. But the issue is complex, and I really took advantage of this opportunity to try to construct a logical and coherent argument to make the case for the digital euro. In fact, my speech is called Monetary Sovereignty in the Digital Age, the case of the for a digital euro. Money plays a fundamental role in society, driving economic activity and enabling daily transactions. Money in physical form, cash, remains the most frequently used means of payments in store, especially for low-value transactions. But more and more people are using money in digital form. An average of 379 million retail transactions are made digitally in the euro area every day. Given money's importance for our material and societal well-being, the regulation of money has long been considered a cornerstone of state sovereignty. As the influential French jurist and political philosopher John Bodin observed in the 16th century, only he who has the power to make law can regulate the coinage. Today, legislators continue to regulate the use of money, and they have entrusted central banks with issuing public money and maintaining confidence in the monetary system. At the European Central Bank, we issue money that can be used to settle wholesale and retail transactions throughout the euro area, thereby guaranteeing the singleness of money across the monetary union. And we ensure that the euro remains a safe, stable, and effective medium of exchange and store of value. This provides an essential anchor for the economy and for the financial system. The euro system has made significant progress in integrating wholesale transactions, largely thanks to the robust payments infrastructure it provides. The euro system real-time gross settlement system, T2, for instance, processes a value close to the entire euro area GDP on a weekly basis, and it has established itself as a leading global payment system. In parallel, euro banknotes are accepted for retail payments across the euro area. They have become a symbol of European integration and freedom, uniting us and strengthening our collective identity as Europeans. But while central banks have long offered digital settlement in central bank money for wholesale transactions, we do not yet have a digital form of cash. This is becoming increasingly problematic because the use and the acceptance of cash are declining. In the euro area, cash transactions have fallen below card transactions in value. And the share of companies reporting that they do not accept cash has tripled in the last 3 years to 12%. The European Commission has therefore put forward a legislative proposal to ensure the acceptance of cash, and the ECB is committed to keep euro cash widely available and accessible. Still, the trend toward less use of banknotes for daily transactions is likely to continue, reflecting the digitalization of economic activity and mirroring patterns observed in many advanced economies. Moreover, digital payments in the euro area remain fragmented, both along national lines and in terms of use cases. Current European digital payment solutions mainly cater to national market and specific use case. To pay across European countries, consumers have to rely on a few non-European providers, which now dominate most of these transactions. And even these providers' payment solutions are not accepted everywhere and do not cover all key use cases. So a key objective of the central bank, that is, to offer the public a means of payments backed by the sovereignty authority that can be used for retail transactions across the jurisdiction, is not being fulfilled in the euro area digital space. This is all the more awkward, given that some euro area countries have made it mandatory to accept digital means of payments, for instance, in a bid to combat tax evasion. In addition, European payments have become a primary example of the situation that Enrico Letta and Mario Draghi have described in their recent reports. The fragmentation of the market, the lack of European payment solution available on a European scale, and the difficulties faced by European payment service providers in keeping pace with the technological advances means that Europe is not competitive within its own market, let alone on a global scale. Moreover, in an unstable geopolitical environment, we are being left to rely on companies based in other countries. Today's dependency on US companies could in the future develop into reliance on companies from countries other than the United States. Platforms like Ant Group's Alipay have demonstrated their ability to bridge geographical gaps. During major events like UEFA Euro 2024, they were able to boost their payment app usage among customers in Europe. We must move swiftly to address the risk stemming from Europe's current inability to secure the integration and autonomy of its retail payment system. This is a key motivation behind the Digital Euro project, bringing central bank money into the digital age to provide a digital equivalent to banknotes and to strengthen our monetary sovereignty. Today, I will outline the policy challenges we face as digitalization reinforces the two-sided nature of the payments market. I will then discuss how the introduction of digital euro could make a significant difference. By designing the digital euro to meet the diverse needs of customers, merchants, and payment service providers, we can ensure its widespread adoption. This, in turn, will empower us to pursue strategic goals such as innovation, integration, and independence, ultimately enhancing our economic efficiency, resilience, and sovereignty. To fully appreciate why we have been failing to overcome the fragmentation and why the digital euro would be a game changer, we must first understand the structure of the retail payments market as two-sided marketplaces. Retail payment systems act as a vital intermediaries, connecting two key participants, merchants and consumers, whose transactions are facilitated by payment service providers. The defining feature of this marketplace is that interaction between participants generate network effects, where the value of each group increases as more participant joins the other side. Consider the telephone system. Its utility grows with each new user. However, on the downside, this also creates a challenging chicken and eggs dilemma. Platforms need a critical mass of users to attract additional participants, but they struggle to achieve scale without that initial user base. That is why platforms with existing large user bases have an advantage in entering such a market. Indeed, the strength of network effect is amplified when platforms expand their range of activities, thereby broadening their user base. Technological innovation and the rise of digital platforms managed by major tech companies are expected to further exacerbate these dynamics. Big techs conduct business in finance in a unique way, drawing on three mutually reinforced components: data analytics, network effect, interconnected activities. Network effect help big techs gather more data, which enhance their analytics. Better analytics improve services and attract more users, allowing them to offer more services and gather even more data. As a result, payments apps provided by big techs have become especially popular in emerging markets and developing economies. Take China, for example. Its financial system has largely disintermediated banks from payment transactions. Indeed, big techs have leveraged the widespread use of mobile apps, integrating social interaction and shopping experience to offer user-seamless digital payments methods. What is even more problematic is that these companies operate closed-loop payment system, in contrast to international card scheme open-loop system. In a closed-loop system, consumers load money onto their Alipay account, for example, and pay by scanning the merchant's Alipay QR code. As a result, funds are transferred directly from the consumer to the merchant, bypassing the traditional system of bank and network processor. Only the owner of the closed-loop system has access to the payment data. This challenges the traditional banking model, which relies on customer data and relationship to function effectively. It also has an impact on how credit is extended to the economy. There is a risk that the closed-loop system developed by successful online platform and big tech companies could, in future, create a parallel economy with their own currencies and distinct units of accounts. At the global level, big techs such as PayPal or Apple have developed a highly successful ecosystem based on closed-loop financial service models. By encouraging people to use their payment apps, this ecosystem effectively obliged them to use their payment rails. In parallel, payment platforms have tried to become more integrated in the social media giants like WhatsApp and Meta. Platforms like X, former Twitter, is considering offering payment functions. And Amazon is now venturing into the credit card and payments app business too. This example illustrates how these firms can exploit customer networks to create cross-subsidized links between various services. However, while network effects can foster a virtuous circle of economic growth, they also pose significant risks. In particular, walled gardens or lack of interoperability between various solutions can result in market fragmentation. Technology can be used to exclude competitors and so can skew the competitive landscape in favor of a dominant player. And this dynamic could further raise the barriers to enter and grow in two-sided payment market, stifling competition and making it even more difficult for European payment solutions to emerge to a pan-European scale. There is thus a risk that the current dynamics, where big tech companies seek to exploit the power of their platform to expand in payments, could exacerbate the challenges facing the European retail pay markets in terms of integration and ability of European solutions to compete and innovate at scale. Since the creation of monetary union, European policymakers have taken significant steps to foster the development of private European payments initiatives that span the euro area. The hope was that this initiative could enhance competition within European payments landscape, providing consumers and businesses with more choices and better services. From the launch of the single euro payment area to the recent adoption of the instant payment regulation, the European Commission and the ECB have worked with the private sector to support integration, innovation, and the creation of a pan-European retail payment solution. Yet, despite this effort, more than 30 years since the inception of the single market and 25 years since the launch of the single currency, most European retail payment solutions remain national in scope, addressing only limited use case. Meanwhile, 13 out of 20 euro area countries rely entirely on non-European solutions in the absence of their own domestic payment scheme. As a result, people who live, work, travel, or shop online in the euro area countries find themselves effectively dependent on two international card schemes, which enjoy strong market power. This situation discourages small businesses from expanding across borders or even into their national online markets, ultimately hindering the deepening of the single market. And paradoxically, the benefit from the effort we make to lower the barrier to trade in European product market might not fully reach consumers, as they are absorbed in the form of high profit by the few international players that currently enable payments in store and online across Europe. Rather than joining forces and sharing resources to develop successful pan-European solutions, national communities have preferred to preserve the legacy of investment made in the past. This reluctance has allowed a few major global players not only to dominate cross-border European payment transactions, but also to steadily capture an even larger share of domestic transactions. The result is that international payment schemes operated by non-European operators today facilitate 64% of all electronic initiated transactions with card issued in the euro area. Merchants and consumers to whom costs are eventually passed on are left to deal with the consequences of this international card scheme market dominance. For instance, the average net merchant service charges in the EU nearly doubled from 0.27% in 2018 to 0.44% in 2022. This increase occurred despite regulatory effort to contain it, as international card schemes exploited their strong negotiation position to raise the non-regulated components of the merchant service charges, such as scheme fees. As a result, every year, European merchants collectively transfer large amounts to international card networks. The cost falls disproportionately on smaller retailers, who face charges that are 3 to 4 times higher than those paid by their larger counterparts. This situation has raised concern among European business of all sizes. While the EU competition authorities can take effective action, they usually do so after dominance has been established. Moreover, they have to deal with the complexity of regulating payment networks. These trends highlight broader competitive issues that have emerged across various markets. In Canada, class action lawsuits allegedly collusion to set higher interchange fees have been filed against a certain bank as well as Visa and MasterCard. In the UK, the payment system regulator has provisionally concluded that there is insufficient competition in the card payment market. The lack of competition allows the two largest schemes to raise fees. Similarly, the United States Justice Department filed a civil antitrust lawsuit earlier this week against Visa, claiming that Visa's exclusionary and anti-competitive conduct undermines choice and innovation in payments and imposes enormous costs on consumers, merchants, and the American economy. It emphasized that Visa extracts fees that far exceed what it could charge in a competitive market, and amounts to an hidden toll, adding up to billions of dollars imposed annually on American consumer and business. And because merchants and banks pass on those costs to consumers, Visa conduct affects not just the price of one thing, but the price of nearly everything. The fact that these issues are not unique to Europe have offered little comfort, particularly when considering that, unlike in the United States, the situation poses a risk to our monetary sovereignty. Excessive dependency on foreign entities in the European payment sector threatens the autonomy and resilience of the European payment services. Without decisive public action, this dependency is likely to worsen. New foreign players, including from China, Brazil, India, are seeking to enter or increase their footprint in the European market. While foreign competition is welcome, we cannot be satisfied that Europeans do not have their own digital payment solution, allowing them to pay throughout the euro area. And we need to be careful that foreign central bank digital currency do not end up eroding the international role of the euro, especially as some jurisdictions are thinking about allowing the CBDC to be used abroad. European policymakers, and particularly the ECB, have recognized these challenges. In response, we have initiated the Digital Euro project, which is currently in the preparation phase. The Digital Euro project is a crucial step toward enhancing Europe's payment landscape and safeguarding our monetary sovereignty. By ensuring everyone across the euro area would have access to central bank money in digital form, the project aims to provide tangible benefits to consumer, merchant, and payment service providers alike. Complementing banknotes, the digital euro would offer all European citizens and firms the freedom to make and receive digital payments seamlessly. During my recent hearing before the European Parliament, I extensively discussed the benefit of the digital euro for consumers, particularly in terms of convenience it would offer. The digital euro would provide a single, easy, secure, and universally accepted public solution for digital payments in stores, online, from person to person. It would be available both online and offline, and it would be free for basic use. At the hearing, I also highlighted how the digital euro would provide merchants with seamless access to European consumer base. Moreover, it would offer an alternative that would increase competition, thereby lowering transaction costs in a more direct way than regulation and competition authorities can. The digital euro would also generate broader benefit for the euro area economy by fostering competition and innovation. European payment service providers are finding it increasingly difficult to compete with the international card scheme and e-payment solution. For example, Apple Pay has significantly expanded its reach in Europe, capturing a portion of interchange fees, which represent a significant expenses for issuing banks. As a result, banks risk missing out on not only interchange fees, but also client relationship and user data. By contrast, digital euro would ensure that distribution would remain with payment service providers, allowing them to maintain customer relationship and be compensated for their services, as is currently the case. It would also offer an alternative to co-branding with the international card scheme for cross-border payments and potentially beyond the euro area, thus promoting competition. The digital euro would expand opportunities for payment service providers while reducing the cost of rolling out solutions on a European scale. In addition, it would cultivate an environment conducive to widespread adoption of payment innovation throughout Europe. Currently, several innovations aimed at simplifying payments are emerging within specific national markets or across a few countries, driven by European payment service providers. Although these innovations are highly commendable and would enhance people's life, existing structural barriers means they would encounter considerable obstacles in trying to achieve pan-European scale. This fragmentation along national lines further impedes private participants' ability to achieve the scale required in a two-sided market like the payment market. What is the end result? By failing to implement large-scale innovation accessible to everyone in the euro area, these companies are unable to achieve the optimal scale needed to continuously invest in new technologies. This limits their ability to compete effectively with the large international players who can fully leverage economy of scale even on a global level. According to the European co-legislator legislative proposal, the digital euro legal tender status, which would require merchants to accept the digital euro for electronic payments, and mandatory distribution would help overcome the challenge of achieving sufficient scale in a two-sided marketplace by ensuring widespread accessibility and acceptance across euro area. This legal tender status, combined with the digital euro rulebook, would establish common standards which are not in place today. Let me make an example to explain this in a simple terms. At the moment, in-store payment terminals often use technology known as the kernel provided by Visa and MasterCard to enable contactless transactions. Although domestic card schemes can currently access this technology for free, multi-country European card schemes cannot. Moreover, this free-of-charge policy could change at any time. In the future, all stores would be required to accept the digital euro, meaning payment, meaning payment terminals would need to support its standards. According to the draft regulation, the standard would have to be made available for reuse by private entities who could use it to develop their services. This would mean that all payments terminals in Europe that support digital euro transaction would be equipped with a scheme-agnostic kernel. This open system would be accessible to both regional and domestic European payment scheme, thereby allowing customers to make contactless payments throughout the euro area. This would advance a more integrated European payment market. As private providers expand their geographical footprint and diversify their product portfolio, they will benefit from cost efficiencies and be better positioned to compete internationally. In essence, the network effect generated by the digital euro would function as a public good, benefiting both public and private initiatives. This approach is akin to create a unified railway network or European energy grid, where various companies could competitively operate their own services and deliver added value to customers. Instead of requiring significant investment to expand existing services across the euro area, the Open Digital Euro standard would facilitate cost-effective standardization, making it possible for private retail payment solution providers to launch new products and functionalities on a broader scale. Ultimately, whether through the digital euro or private solution, this standardized framework would unlock innovation, create new business opportunities, and improve consumer access to a diverse range of goods and services. The design of the digital euro, as well as the key provision in the regulation proposed by the European Commission, contains all the key elements required to make this vision a reality. Over the past years, we have extensively engaged with a multitude of market stakeholders, including through Rulebook Development Group and the Euro Retail Payments Board, to shape the digital euro value proposition and prepare its implementation. We have collected and discussed the input of the payments ecosystem at large, including from representatives from consumers, merchants, banks, and other payment service providers. In the coming months, we will expand our cooperation with the private sector, focusing on three main themes. First, how to create a more competitive environment to encourage innovation and offer consumer more choices. Second, how to best identify and leverage synergies to enhance efficiency and create mutually beneficial opportunities across payment ecosystem. And third, how to strengthen the business model of all stakeholders, ensuring that they can adapt and thrive in a rapidly evolving landscape. Each of these value drivers will be discussed in depth, taking into account the different roles in the payment chain, including those of issuing bank and third-party providers. By adopting this inclusive approach, we can ensure that everyone's needs and perspectives are addressed, paving the way for a robust and dynamic payment system. Let me conclude. Money is key to sovereignty, a reality that resonates more than ever in a digital age. Some 63 countries are now operating, piloting, developing, or exploring retail CBDC. Meanwhile, major payments solutions are expanding global, and some nations may even seek to leverage crypto assets, with figures such as US President candidate Donald Trump promising to make the United States a Bitcoin superpower. In this fast-moving environment, Europe cannot stand still. And the role of the ECB in issuing money that is accepted throughout the euro area is particularly crucial in a monetary union where payments markets remain fragmented along national lines. We are committed to ensure that people in Europe can continue to use cash. However, we cannot stand by and watch as individuals are unable to use central bank money for daily digital transaction. Bringing central bank money into a digitalized world through the digital euro would safeguard our monetary sovereignty in a digital age. It would overcome fragmentation by offering money that can be used for digital payments in the euro area, fostering competition and innovation by facilitating the development of a pan-European payment services and strengthening our autonomy and resilience by helping us avoiding becoming over-reliant on foreign payment solutions. Thank you for listening. So I can take questions.
Thank you very much for those comments. I have a question about implementation in the following sense. You've made the argument that a key portion of this story is implementing platforms European-wide. How much of that is going to require a public-facing awareness of the euro as opposed to a facilitation of the independent platforms being able to link into such a system?
So this is a very complex project and dynamics. I must confess that the level of awareness is not equal across Europe. So if you speak with people expert of payments, they fully understand that, right? Other people might say, as was the beginning of the presentation from a colleague before, they say, but why do we need this? We have so many means of payments. I don't need, because people do not understand the difference between commercial bank money and public money. So, but this cannot stop us, because the reality is what it is, right? We cannot. We cannot continue to rely on solutions that may stifle innovation and make our life harder. So what we are doing basically is trying to expand the awareness on this. This is part of our engagement every day, talking to politicians, talking to the people. Obviously, as we get close to the launch, and I will say something about this, we will step up our communication with the public, make them aware of the benefits that digital euro will bring. Just to give you an example, in Europe, there are only 2 jurisdictions that have peer-to-peer payments. We have the technology, we have everything to do that, yet the market is not. This is kind of, restricting the freedom of people to enjoy services. The digital euro will be a unified platform, allowing everybody with a single means of payment to satisfy all needs throughout Europe. In this sense, digital euro is very much the cash of the digital era, and that's where we keep insisting, and our communication will be focused on this. However, the ECB will not issue digital euro until we have in place a proper legislation that allows us to do that. This discussion is very much going on in Brussels, both in the Parliament and the Council, and we are supporting them in deciding. So this effort, what you were asking about the level of awareness, we are working to increase this level of awareness to make people realize how important it is for the sovereignty of the Europe this project is. I don't know whether I answered to your question.
So thank you very much for your speech. I totally agree with you that central banks and the ECB cannot stand still and close the eyes against the background of digitalization and has to adapt and to prepare for the repercussions of digitalization on the payment system, on the monetary system. I think there we all agree. A central bank cannot stand still. What is not so clear for me why this necessarily means you have to issue a retail CBDC. Why is it not enough to have a wholesale CBDC? And that I would be interested in your opinion on that. So,
yeah, well, no, that's a very important question, and I'm not saying so to please you, it's true. I mean, we have been discussing, as Martin was saying, this project began in January 2020, and we spent almost 1 year to define the scope of this project. So we were confronting with two different needs. One need is to make the wholesale system more efficient, taking advantage of new technological innovation. I'm referring to DLT. This would definitely improve the efficiency of the wholesale transaction, both asset and the central bank money, cross-border payments, wholesale, because at the end of the day, you put everything on a single platform, you can have DVP instantaneously. This might improve enormously the situation. However, is this the most important need that we have? What we were facing is, what I tried to say, is this fragmentation of the European retail payment system. And I don't know how you address this with wholesale. Let me give you an example. Last night I was coming here from Lisbon. So I was flying on European soil. I was on a European carrier. And if I want to buy a sandwich, I had to pay with an American credit card, debit card, or whatever. To me and to us, this is the most pressing need to solve this fragmentation problem. And believe me, we have been trying for 25 years to do that. And we have tried almost everything, encouraging the private sector, even providing an infrastructure. We have a very sophisticated fast payment system in Europe, which is called TIPS. It's very advanced. And yet, because we did not step in the front end, trying to push the very last mile and make sure that the last consumer could enjoy this new technological advantage, here is the situation. After almost 10 years since the instant payment regulation, after almost 6 years after the presence of a technology, you can do an account-to-account payment in Europe in 10 seconds for a cost that it's peanuts, and yet the market did not develop. So we thought that this is the opportunity to do two things: to provide these means of payments that would unify us, very much like cash, first. But even more important, and this is extremely important to understand, we are providing an infrastructure that all private solutions in Europe can use to reach out their client without the needs to develop their own acceptance solution, which is the problem I try to illustrate. When you have these two-sided markets, in order to scale up, you need to be able to, the merchant need to be reassured that, he has enough clients paying with that solution to make the investment. Basically, because of the digital euro imposed the universal acceptance, the market will move toward these standards, and everybody will enjoy. It's really like developing a common railroad in Europe where everyone can put their own train and compete.
Thank you very much for that, Dr. Cipollone. I wanted to ask you if you see a tension between two of the problems that you raised that need addressing, one of which is the rise of the digital economy and the decline of the use of cash and the need for a digital cash, and the other of which is the strategic autonomy and fragmentation of the existing payment systems in Europe. And I'm asking whether you think there's a tension here, because it would seem that if we assume that, as you've said, that we want to maintain the relationships between consumers and payment services providers via accounts in a digital euro, then this would conflict with some of the foundational aspects of what makes cash work, which is the ability to hold it outside of accounts, the abilities for consumers to be private when they transact, and ultimately the ability for them to have possession and control.
Let me put in this way. There are use cases that cannot be addressed by the cash, chiefly e-commerce. And this is particularly concerning because with cash we cannot address a growing need of the economy. On the other hand, commercial bank money solution allows you to cover only part of this new additional. So the issue is how do we bridge the two? So we need to kind of invent a banknote of the digital era. What is it? Why there is no contradiction? Because by allowing PSP banks to have an additional card in their deck, they will retain the customer relationship which otherwise could leave because somebody else is able to provide these services that they are not able to. So what could happen is that the payment industry will leave the banks and thereby undermining their ability to do their job. So essentially, I don't see any contradiction because for the part that you can handle only electronically, I mean, you cannot do that. But in order to preserve the privacy of the transaction, we are also offering the offline solution, which allow people to pay without revealing to anybody the nature of the transaction. So are we really trying to bridge the two worlds? So far, I think we have a good value proposition because we really are trying to combine the two worlds together.
Yeah, thank you for your remarks. I'm from the technology side, and I was very happy to hear that you mentioned the open digital euro standard. So the first little question is, when is the standard open? So when technologists look at the project, it appears particularly obscure, in particular compared to other central banks' digital cash initiatives. And then we have a lot of experience with open standards, for example, for the internet. And we know that only a tiny little fraction of the standards is successful. So what makes you so confident that all the properties that you expect will actually be fulfilled? And for example, I wonder what is the track record of the Eurosystem in designing standards for digital technology? And then even if the standard does not live up to the promises that you describe, do you sense that there's a potential risk that this essentially spills over to distrust or reduced trust in the euro system or the euro itself. For example, if a small side property such as data protection or privacy is not fully fulfilled?
You know, any such project of this relevance carry the risk you are mentioning too. So, I mean, it would be extremely pretentious from my side to say that we have solved all the problems. But we have a short history, but it's an important history. In 25 years, we have implemented a wholesale system that works pretty well. I'm referring to Target 2. I give you the number, right? Target 2 is able to process amounts that is about the value of the euro area GDP every week. We have implemented this solution, which is called Target 2 Securities, which also brings in a unified platform trading of assets and central bank money. It's working pretty well, and it's robust. We have implemented this retail payment solution, fast retail payment solution. I think Eurosystem was the first one to invent it. And then other people came along, which is called TIPS, which is able to close a transaction in less than 10 days. 10 days. 10 seconds, I'm sorry. So all this experience speaks for, an ability in some sense of the euro system to live up the promises make. But we are not alone here, right? We are discussing with all European experts on this front. We have experts at the central banks. We are talking to the society, to the private sector, part of the procurement. I mean, we are not doing everything in Frankfurt. There are, many people. We are just beginning. Actually, we are in the phase of procuring this whole process. So we are involving private sector in providing the basic services. What we are doing is that retaining. Yes, you are right. We are retaining at the Eurosystem level the core of the system, because we don't want to be dependent on someone else that tomorrow cannot be there, or be trapped in some problem that we don't know how to solve. We need to keep our ability to talk to the private sector so that we understand where they are. For example, we are discussing with them, and we will be looking at possible solution on privacy to implement more and more advanced solution as they become available in the market. So we have not solved all the problems, but I think we have a good track record so far that remaining humble, open, ready to discuss with with the expert, with people that have knowledge on that. And Europe is not in a bad position to do that. We are confident that we can bring this knowledge within the Eurosystem and develop a system that is able to fulfill the promise we are trying to.
Dear colleagues, I have many more demands for questions, but it's my duty to guard our schedule. And I'm afraid that I have to close the public discussion here, being aware that there are many more questions, but we have now lunch, and I would like to first thank you again, Piero, for your generosity to share your thoughts and engage in this discussion. And I'm confident that during the lunch you might, place one or the other question to Piero. And let me join me in thanking Piero again for his
Thank you. Thank you for listening.
Good afternoon, everybody. So, see, at least a few people are still there. So, after 2 days of intensive discussions, presentations. We have finally reached the last but not least session. We have 2 presentations. Here, I'm Franz Seitz, Weiden Technical University of Applied Sciences in Germany. I'm the chair and will guide you through the session. And we start with a paper by Philipp Unding on negative interest rates. So the floor is yours.
Perfect. Hi from my side, I'm Philipp. I'm from the University of Vienna. First of all, before I start, let me say thank you for having me, for this opportunity to present. And I'm going to talk about the macro-financial effects of negative household deposit rates. Footnote, thank you for supporting this project, OeNB, financially, so that I could do that. And yeah, let me set the stage and start by motivating this project in the theme of this conference, or one of the themes of this conference, how is this related to central bank digital currencies and how can we think about it? So as we've learned, or as we've heard, as you all know, central banks have, so CBDCs have garnered significant attention from central banks all around the world. And during this process, one of the key design characteristics was the interest rate. Over time that developed, that was seen as one of the key design characteristics of a CBDC. That's highlighted, for example, by numerous academic contributions, how the remuneration can affect the demand for a CBDC, how it can affect its stable introduction, and so on and so forth. But not only by academics, it's acknowledged, but also by policymakers, which you see a quote here below, which is taken from the reaction from the ECB to a legislative proposal on the establishment of the digital euro, and it reads, given its mandate to maintain price stability, the ECB cannot exclude future scenarios where remuneration of the digital euro might be warranted. So while they might not plan on actually remunerating it, they still know that it is an important policy tool for them and they might need to do it in the future, or at least they want to keep their right to do it in the future, right? So they acknowledge its importance. However, we have no data to empirically test how interest rate changes would affect the CBDC because there's no introduction of a CBDC on a large scale that we could use. So an alternative that we could do as researchers to inform the policy debate is to analyze interest changes on deposits, on deposit accounts, checking accounts as we call it in the US. Why is that relevant? Well, because in almost all CBDC proposals, those two are directly interchangeable for each other, right? So you could go to your bank, the idea is you could go to your bank and you can exchange your deposits for CBDC and do that. So most of the dynamics, or at least a proportion or a fraction of the dynamics that apply to these deposit changes or effects of interest changes on deposit accounts would also apply to CBDC balances, okay? So what do we know about interest rate changes? Well, in positive territory, I would argue they're well studied for the most part of it. In negative territory, it's a bit of a different story because we haven't had negative interest rates historically. Contributions concerning the effects of negative interest rates focus mostly on the effects of policy rates in general, and more specifically also on the effects, does it work? Perfect, on corporate deposit rates, so deposit rates that firms face. However, until recently, there was next to no evidence on negative interest rates on household deposit accounts, so checking accounts on which you and I get our salary. What I'm going to talk about today is one main exemption in the euro area, and that's Germany. So what happened in Germany is that more than 400 German banks introduced, and I'm going to use the German term, I'm sorry, the so-called Verwahrentgelt on these deposit accounts, which is a negative remuneration, usually equal to this deposit facility rate. So the rate at which banks can deposit their excess liquidity at the central bank, so minus 0.5%. So what banks did in Germany, they passed on these costs to their private customers, household customers. And throughout the presentation, if you see the term NIR banks, or near banks, as I used to say, because I'm used to it, that's referring to those banks that have introduced these negative interest rates, negative household deposit rates, to be precise. That policy was very salient in Germany and heavily discussed in newspapers, again, German newspaper articles, like headlines. Why? So banks do not want you to save. List of shame, these banks charge negative interest rates. What now, rich man? Okay, so all of this stuff in the German media, very salient, very heavily discussed. So what I'm doing in this project is I'm studying the effects of this introduction of negative household deposit rates on balance sheet positions of German banks. I'm going to ask myself the questions, are household deposits affected by this policy? And if yes, how? And in the second step, I'm asking myself, well, does it affect the transmission of monetary policy? So is credit creation affected in some way? Okay. To do that, to answer these questions, I'm conducting a staggered diff and diff analysis. So I'm in the flavor of most of today's presentations. So diff and diff is on the menu. And I'm going to employ some new and robust estimation techniques that deals with some problems that are associated with the setting that I'm facing. And I'm using a novel and self-collected data set so that I collected and that I merged with data from the German Bundesbank. All right. Here I'm going to skip that. Concerning the data, so I collected data myself, so I went through all these websites of German banks, I wrote the mails, I called them, took me several months, and what I end up with is a self-collected data set that contains information on these banks that introduced negative household deposit rates. It contains the name of the bank, the date of the introduction, monthly, so it's monthly data. I know when the banks have introduced these negative household deposit rates, and the rate charged, even though that's not very interesting because it's uniformly minus 0.5%. And what I've been silent so far about is that these banks also introduced exemption limits in tandem with these negative household deposit rates. What does it mean? It means that usually these rates did not apply from the first euro on your balance, but only for balances that you hold in excess of a certain threshold. Let's say 10,000 euros, 100,000 euros. I'm going to show you more about that later. Okay, so I also have information about that. And what I end up with is data on the introduction of these negative household deposit rates for 341 banks out of a total 483 banks that have introduced them. What's with the missing banks? Well, I guess that's empirical work and problem with data collection. You know, they didn't want to cooperate, they could not force them. So I have data for 341 banks out of 483 banks. I made sure that my sample is, or I checked that my sample is representative for the whole sample along several important dimensions like deposit intensity, bank size, so it fits and it's representative. What I then did is I merged this data with data from the German Bundesbank, mostly balance sheet data, and data to clean the sample, and I ended up with the final data set here at the bottom, which covers the German banking universe, and it has monthly frequency from May 2018 to June 2022. So that's my period of study, more or less. So that's the setting. What I'm going to do now is I'm going to show you some descriptive statistics about the data that I collected. Then I'm going to give you a very brief idea of how my estimation strategy looks like, and then I'm going to go through the results. Okay, so a lot of pictures, not much math. So what you see here is the distribution of these banks along bank types and kind of a geographical distribution. Okay, so on the x-axis you see NIR, banks that have introduced them, banks that have not introduced them. So you see that most of the banks that have introduced negative household deposit rates were actually either public banks or cooperative banks, while the other banks, which are mostly private banks and big regional banks, not as many of them introduced them as the other two bank types, okay? So what are these cooperative and public banks? They're banks that are very characteristic for the German banking system. And what you need to know about them or why they might be overrepresented in the sample of negative household deposit rate banks is that they're usually characterized or they follow the so-called house bank principle according to literature. So they do not maximize their profits in like as a first order maxim. But what they do, they operate very regionally or locally, and they have long-lasting relationships with the customers, which is like the #1 priority for them, like the success of their customers and their regional operations, which means that they're usually characterized, again according to literature, by a lower average productivity and profitability. And now, negative interest rate policy is around. It's a very challenging time for banks, and these banks were the first to pass on these costs also even to the private household depositors. Okay, so that's the mechanism that's behind that. At least I'm pretty sure about that. And then on the right panel, you see distribution according to East and West Germany. So you see many more banks have their headquarters in the western part of Germany, and in absolute numbers, more of them introduced it there, so the negative household deposit rates. In relative terms, actually, more banks in Eastern Germany introduced it relative to the total number of banks. Okay. I also have a map of Germany if you're interested in knowing the state distribution. So now let me have a few more words about the exemption limits. So you see they're quite dispersed if you look at the panel on the left. So on the x-axis you see the exemption limits ranging from 0 euros to more than 350,000 euros. I think the maximum was 500,000. Yeah. So some banks reduced these negative household deposit rates only for people for balances in excess of 500,000 euros. But some introduced them also from the first euro onwards. And you see they bunched at some focal values like 10,000 euros, 20,000, no, 25,000, 50,000, 100,000, and so on and so forth. Okay. On the right-hand side, you see the average exemption by date, meaning each bar here represents the average exemption limit for all banks that have introduced negative interest rates up to this point in time. So what this graph shows you is that the policy became more stringent over time, okay? So these exemption limits introduced, meaning they were more binding over time, became more binding, okay? Good. To give some more meaning to these numbers, the average German household holds funds in these deposit accounts about between 9,000 and 13,000 euros. Yeah? So usually these exemption limits were in excess of those funds for the average customer, okay? A few words on the date of introduction. So you see the first bank in my sample introduced negative interest rates in May 2019 and the last one in April 2022. There's not a clear pattern here. It like increased in late 1919, early 2020, then decreased a bit and then took up again. Here on the right-hand side, you see the cumulative number of banks, okay? So you see it starts slow and then it picks up and then towards the end, towards early 2022, it slows down again, probably because the end of negative interest rate policy was kind of predictable, yeah, in the financial sector. Like you could see the end coming, okay? So much on the descriptive statistics. What I'm doing empirically is, as I said before, a different diff strategy. So in my case, for all what I'm going to show you today, I treat them as binary. So either you have introduced negative household deposit rates or not. Treatment is irreversible, so I check that banks that have introduced these negative household deposit rates did not abolish them before or during the period of study. And as I said, my treatment is staggered between 2019 May and April 2022. And given my design characteristics, the most commonly used method here is a two-way fixed effects estimator, which was the workhouse model in this different diff literature. However, it has been shown in recent years that, in settings like mine, which with a staggered introduction and potentially dynamic and or heterogeneous treatment effects, so treatment effects might change over time and they might vary across banks. Well, the two-way fixed effects estimator might not be a good estimator and you might run into problems. So I followed the guidelines from literature. I used some diagnostic statistics before and then used the estimators to yield, to most likely to yield unbiased results. And I end up with these three estimators. So I'm going to show you results for these three estimators. First one is the Keller-Wentz and Enner estimator that estimates group time average effects, and then I'm going to sum them to event study effects. Second one is the one from Borusiak, Jaravell, and Spies, belongs to the class of imputation estimators, where you impute this potential non-treated potential outcome that you do not observe. And for robustness purposes, I also employed a two-way fixed effect regression approach, well, because the diagnostic statistics have shown that in my case, I actually don't run into big problems. So if you're notice literature, I do not run into negative weighting issues, and the weights attached to these comparison groups between early and later treated groups are very minor. So the weight attached to these comparison units is very minor. So those are the three estimators that I'm going to use. They're going to be abbreviated by CS, BJS, and two-way fixed effects, okay? And that's going to bring me to my main result, which is here, this graph, okay? It's kind of loaded, so I'm going to go through it step by step. So what you see here is the effects of the introduction of negative household deposit rates on the amount of household deposits by banks, okay? The dependent variable is scaled in as natural logarithms, so the small deviations from zero can be interpreted as percentage changes. And as you see, within the 12 months of the introduction of these negative household deposit rates, these banks experienced a reduction in their household deposits between 2% and 3%, okay? Statistically different from zero. Pre-trends are not statistically different from zero, and you see all these first sign of the robustness of the results. These estimation strategies actually all yield very similar results. I also tried some of the other ones that are out there from Hautefeuille and Chez Martin and so on and so forth, and they all look similar. Yes. Have I said everything that I wanted to say? Yeah, here, so on the x-axis, it's months from treatment, right? And significant effect, okay. How much time do I have left? Around 5 minutes? Fine, 6, yeah, perfect. Because, yeah, that's what happens sometimes. I tend to talk fast, so I'm sorry. If you have questions afterwards, it's okay. I'm going to show you some two subset results that I have. I have many more in the paper. I decided to show you two. Here, the effect on different groups of households who reacted seems like the economically independent households, as they're called in this balance sheet from the German Bundesbank. They're self-employed people usually. They react the strongest with like an effect of up to -4%. Then employed household, which also includes retired people, still show a significant effect. And for the other households, which include school children, housewives, infants, students, and people not disclosing their occupation, I do not find a significant effect here. Okay, so there seems to be some story going on of financial means that you have, maybe in financial literacy, maybe how much attention you pay, but I can't do any more mechanism testing here. What I have as well, which might also be interesting, is that I subsetted my sample by exemption limits, because it's kind of sensible to think that banks with lower exemption limits might have experienced a stronger reaction, a stronger reduction in their deposits, household deposits. That's true to some extent. So you see that these three groups reacted. So all banks with exemption limits below 26,000, then between 26 and 50,000, between 51 and 100,000, these banks experienced a significant reduction. Banks that had exemption limits in excess of these 100,000 did not experience a significant reduction in their household deposits. Okay. If I wanna, so usually in the literature, what was brought forward is an argument why we did not observe negative interest rates on household deposit rates, was actually that there's a high substitutability of household deposits for cash or other alternatives, right? So they could have it should be easy for us to reduce our financial means below 50, or like holdings in our deposit accounts below 50,000, according to literature, yeah? Now I can bring it forward as a reason, why I might have seen effects, because it should be rather easy for people to react to this policy. Another aspect that has been emphasized in literature is this behavioral aspect. So people might perceive it very differently whether you cut rates from 4 to 3% compared to 0 to -1%, because all of a sudden you start taking away money from them. Yeah? So this could be also a driving factor of the strength of the results, an explanation for the strength of the results. Also, if you think about the magnitude of the exemption limits compared to the average funds that these people hold in these accounts, also kind of goes in the direction that there might be some behavioral aspect playing a role here. Okay, and the third thing that I was talking about is transmission of monetary policy is kind of a weaker result, and you should interpret it with caution. I'm going to come to that, but you see, again, very loaded graph. You see, again, the three estimation techniques, and you see that banks, after they've introduced negative household deposit rates, experience within the first 12 months after introduction an increase in credit creation between 1 and 2%, depending on estimation technique. Okay? Again, statistically different from 0, weakest for the Kellowens and NR estimator. I think I should do some more explaining here how I interpret the results and how I think about them. So what I cannot do with my data is exclude concurrent changes on the supply side. So I cannot control for loan rate changes, so that might play a role here. Still, it's a staggered treatment, and I still find a concurrent effect. So what I'm picking up here is that banks had several ways of reducing. So the aim of this policy by banks was to reduce their excess reserve holdings, to ease the burden on their bank profitability, because they had to pay punitive interest payments to the central bank. So there are two ways of doing that. On the one hand, they could introduce negative household deposit rates and reduce their household deposits. The second thing that you could do is increase credit, so hand out loans, and a fraction of these loans then usually is used for buying things. If you buy things from another bank, your reserves are going to flow to another bank, so you're also having experience a reduction in your reserves. And I think that's what I'm picking up here with this finding. What I'm showing at least is that there seems to be something going on with the transmission of monetary policy if you introduce negative household deposit rates as a bank, right? And up to now, this channel has been considered as completely muted because there was no evidence of negative household deposit rates in the euro area on an aggregate level. I did several robustness checks. I checked for regional disparities because one concern was, there might be regional clustering and something going on there. I found nothing. The effects are very robust to all things I do. I did placebo tests using alternative dependent variable that should not have been affected and were actually not affected, like deposits by the central government or foreign customers that have not been affected by the policy. I used also only the not yet treated, so I used an alternative control group. I tested with sample length and sample splits and so on. So far, the results seem very robust to all these aspects. Perfect. I'm actually early. That's good. Pays off if you speak fast, apparently, in some way. So what I've shown you today is evidence of a not as binding zero lower bound for household deposit rates in Germany. I showed you that a significant fraction of German banks went below zero on these household deposits. They experienced a reduction in the household deposits and an increase in the household loans. And I provide additional evidence on the functioning of monetary policy under negative interest rates with this research. And to come back to this theme of the conference, so you see it's not directly a paper about CBDC, but what you can learn, I think, is that, it seems like people react very strongly to negative interest rates, at least in Germany. And if you would introduce them, if you would have reason to introduce them, a careful calibration would be necessary, according to these results, if you believe them. But they also show that you might have the potential to directly affect or more directly affect the transmission of monetary policy by introducing a CBDC and then potentially charging negative interest rates on that. Okay, with that, I thank you for your attention.
So the discussant is Burkhard Raunig from the Austrian Central Bank.
Okay, so hello everybody. Everything I say is my opinion and not the one of the ECB or the European or the Austrian Central Bank. Usual disclaimer. So I got a job offer from one of the organizers, strictly analog technology. Helmut Stix was shouting from his table to my table, "Do you want to discuss a paper?" And I said yes, and it was. Often jobs are not that nice, but this one was a really nice job, and I really enjoyed the paper. And I want to be, given that we are nearly at the end of the conference, I want to be brief, and I want to make just a rush through the paper, and I have to make some comments. So I have to talk about a little bit about things which are not in the paper or here is not said, which are in the paper but are not mentioned in the talk. So the motivation of the paper is pass-through of negative policy rates to household deposit rates. Then effects on deposits and lending, household deposits and lending. And the third motivation was given CBDC and relation to negative interest rate policy. So was the motivation. So what I see as the main contribution, first of all, is the data set. I mean, this is a self-collected data set. This is a huge amount of work. That's really a pain, and I think tough work, and he really was able to create a unique and novel data set on German bank, micro bank level data. And the second main contribution, I think, is the empirical study, which is done very carefully. And what is especially mentionable is that he really tried to, let's say, to include the latest research on different methods, and really took this effort seriously and tried to implement really advanced techniques. So this is an ongoing field of research, and the whole point of this why it's so complicated. The usual two-way fixed effects model does also comparisons with treated and formally treated units in the case of a staggered treatment, and this creates problems. If the weight of this false comparison gets large, then you get all kinds of biases in the estimates, and we really made a big effort to control this bias and to reduce this bias as good as possible. So the main findings of the paper are, so there is no binding zero lower bound. So in Germany, about 25% of German banks introduced some form of negative interest rates. So there have been papers and theoretical papers to assume that this would be binding zero lower bound. In Germany, this is not the case, and he has documented that. And also the main finding, one of his main findings is that the banks faced an outflow of household deposits of about up to 3 percentage points within the next 12 months. They introduced the policy. And the third point is that loans increased by about 2 basis points, so which is in some sense consistent with empirical evidence on the effectiveness of monetary policy on the effectiveness of monetary policy. Now I have some general comments. As I said, it was a very good read, so I got the paper, and the paper was very well written, so you could really understand what he was doing, and he was getting to the point quickly. As I said, he is strong in dealing with biases to staggered treatment, and But what I think, as a general comment, is the explanations for the negative interest rates for household deposits. To me, it's more plausible than for bank lending. So I will come to that later. So I had one maybe it's my ignorance, but the word credit creation, the term, I haven't heard that so much. Simply bank lending or providing credit, supply credit. Credit creation, I've not heard that very often. Maybe I've ignored this term in the literature, I don't know. And he also tries to explain, he didn't tell us in his talk, but he tried to give as one of the explanations a credit constraint story. The bank would be less credit constraints after introducing negative interest rates, which is probably not the case because there was very much excess liquidity at that point in time in the market or around. So now I come to the more specific comments, and as you've noticed, the paper starts with CBDC, and if you read it the first time, you think the main focus of the paper is on CBDC, but then you see, in fact, the main focus is on negative interest rate policy and its transmission and pass-through. So I would suggest if you send it somewhere in, it's better probably to start with the main issue and then afterwards make a link to CBDC if you wish so. And you also find that negative interest rate on household deposits increase lending. This is a finding. So, but what about the causal mechanism behind that? And at that point, I think you cannot simply ignore the fact that there was this TLTRO III program. At the same time, you had this negative interest rate policy. I think, in some sense, I think it doesn't conflict with your results, but I think it's maybe part of the explanation. Although I think it doesn't affect the estimations. I will make that clear in 1 second. So TLTRO III was around, and I think, and you mentioned it in the paper, but you didn't say it, that you heard talks that people wanted to get rid of deposits. I mean, this is this is what you find. And you have the Hausbank principal, Hausbanken here, and they're very much dependent on deposit financing. So if TLTRO III refinancing is cheaper than deposits, then the best thing is you will get rid of the deposits as much as you can and refinance via the cheaper TLTRO thing. So I think part of this story, I think, is going, or maybe going on, I'm pretty sure is going on here. It was simply stable financing by TLTRO is easier and cheaper than via deposits. So these banks had a lot of incentives to introduce negative interest rates to some extent. That this doesn't at all make the estimation invalid, because I think this TLTRO thing, much of it you capture by the fixed effects. So in that sense, you are controlling for that in some sense, for much of it. So this fact will not destroy your estimation results, I think. So, but I think you have to mention it. If you want to talk about bank lending, this happened exactly at the same time. I think you have to bring it into the picture. And there are also some other stories you can imagine. You introduce negative interest rates. So what people think, so a bank comes to you and say, okay, I offer you another product at the same bank, which is maybe more risky, but has better profitability. Or you say, okay, before I take the money and leave it at home, I buy a car or something, I do credit financing because credit is so cheap. So there are various mechanisms that could explain this. And the last point is a technical point here, which is I think very interesting to think about, because as I got your results, you found that negative interest rates on deposits drove up loans, and the loans, as you mentioned in the paper, which you didn't have time to tell here, of course, have an effect on deposits, because if you get a loan, then it ends on your deposits in the first place. So you have to control for loans, and if you do that, so loans is a mediating variable. If you control for that, you are estimating the direct effect of this negative interest rate introduction on deposits. So, but you have, in fact, you have more effects. You have direct and indirect effects here. If you don't control for loans, you get the total effect. And this effect might be smaller because lending more increases deposits, negative interest rates decrease deposits, so the net effect could be positive, negative, or zero. So one could simply try to estimate it. But in the end, what's really interesting, I think, is the direct effect. Because as I said earlier, it's quite credible that your estimate is all right. So there is something going on here. But what I would find interesting is to explain a little bit more the mechanisms behind what happens, why, for example, in particular with respect to loans, to the loan story. I think I buy completely the deposit story. The loan story, I think you have to explain a little bit better, more, not doing more estimation, but explaining more a bit what do you think the banks did to, what was the causal mechanism that got the introduction of negative interest rates on deposits to increase the loans. So there, as I said, there are several possibilities. It would be interesting to know more about it. But I think that's basically it. Otherwise, it's a wonderful paper, and I really enjoyed reading it, and it was really, really well done. So it's a really good read, and I hope you can publish it in a very high-ranked journal. Thank you.
Q&A session. Jamie, you're the first.
Thank you very much. To what extent do you know whether the decline in deposits came from accounts that were over the threshold or from accounts that were within the threshold?
Yeah, unfortunately, I don't know, because I have data at the bank level, but I can tell you because I called 300 of those banks, more or less, because they were not able to give me answers with mail and stuff. So I know from anecdotal evidence that most of these banks are very small banks. That should be made clear, and they told me that they're targeting specifically some of their customers. So they targeted these high, so there seem to be some people that hoard a lot of money in these deposit accounts, and they try to target those. Usually get them to invest with them somewhere else, shift their funds somewhere within the bank. Yeah, that's what I got, but I don't have data on that, unfortunately, so I cannot test that somehow. Yeah.
Next.
So basically, I think you have answered the question I was going to ask. But so, do you have an idea whether the more prevalent response of the depositors was to move their money, for example, to another bank, so they can, like a bank that did not charge negative interest rate, or I know you're working on aggregates by banks, but maybe so I think you could capture some of the at least flows between banks to some extent, of course not directly. But so was it moving money to other banks, or moving to other financial assets or real assets? So was there like a portfolio reallocation on the household side from on the whole data set? What do you think was the main reaction from this perspective?
Yeah, it's a good question. So as I said before, I don't have the data, so I don't really know. What I know, of course, I tried other dependent variables, right? So I looked at savings deposits and other things that I could see in the balance sheet. So I do see a slight increase in savings deposits, but it does not match these results. So I do see a slight increase. I know from anecdotal evidence from several banks, I cannot tell you how many, but it's like, I don't know, double digits from calling them. They said, we are actively, like more said, but we are actively trying to keep the customers at the bank, but get them to shift their funds out of these deposits. And then I don't see it anymore. As soon as they invest somewhere else, it's off the balance sheet, and I don't see that. Keep that, yeah. So that's all I can tell you. I tried these flow stories, so I got that comment once, that I can try to observe like the flows somehow. I haven't managed to do that, to be honest, so far. But that's something that I'm still thinking about, yeah.
Charles?
So given the special nature of it, it isn't going to be comparable, but can you get a gauge at how much this elasticity compares with the elasticity just above zero?
Yeah, no. But it seems like I've gotten a like elasticity seems to be very high, right? Like it's a 0.5% change with exemption limits, and it's like a 3% change in deposits. So it seems to be a very, very quantitatively very strong effect. Yeah, I'm not so sure how much I can say about that. Yeah.
Kim?
Yes. So not a question, not a comment, but an encouragement. There was a paper in 2002 called "The Welfare Cost of Inflation." And, from a micro household point of view, you could actually do the welfare cost of deflation, and you can answer these questions, because one of the things that people have always said about cash was that we should abolish cash because there's negative nominal interest rates, and you could do the quantitative assessment now.
Yeah. Thanks. Great comment. Gonna look at that.
So, is there anyone in the back or no?
Yeah. Thank you very much for your very interesting presentation. I also have a question with respect to people shifting money. I was wondering, is there any information about the number of bank accounts? Is it, for instance, is it increasing? Because I can imagine if you start to shift money from one bank to another bank, that you still keep your bank account at your original bank, but you start shifting money above the threshold level to other banks. And maybe after the negative interest rate was away, that the number of bank accounts was going down again because it wasn't needed anymore to shift your money from one bank to another.
That's a good comment. I haven't, so I know that in the data set that I have, I don't see the number of bank accounts, but maybe I can get that somewhere else. To be honest, I haven't thought about that. That's a good point. I could see whether, yeah, I'm doubtful that I see it in the aggregate, but maybe, could be, yeah, thanks. Cool.
So here in the back.
Hello, my name is Michael. I'm also from the Austrian Central Bank. I have a question about your equations, your estimation methods. I would say there could be a co-founder, and this could be TLTRO uptake or TLTRO rate, because exactly at that time you're looking at the data, there was a reversal of the central bank rate. Actually, the ECB is the first time in the history of, I think, any central bank where depositing at the central bank was remunerated with minus 0.5%, and borrowing from the central bank was minus 1%. So you have this effect that actually every bank tried to get rid of depositors because they had so much excess reserves, and excess reserves were remunerated by around at least 0.5%. So I think this could be a very confounding effect for your result, and they should try to control for that in your main equations. And so the minimal reserve requirements, usually you want to get rid of them, but during that time, it was great to have them, basically. Yeah. So it was a race of having as much collateral as possible and keeping the funding for lending conditions. So maybe also lending, as Burkhard pointed out, is important because banks needed to do the funding for lending just to get the best rate. So I would also try to control for that. Thank you.
Yeah, thanks. Great comment. I need to think more about that, to be honest. So I haven't thought about the role specifically of TLTROs, but I would be very happy to talk about that in more extensively afterwards. But that's super good comment. Thank you.
Okay, last question. Here, okay.
Yeah, thank you, great paper. I just wanted to echo Burkhard's comments on the link to bank lending. Like if you think of the deposit channel of monetary policy, I guess you would usually think of deposit outflows having a negative effect on bank lending, but you find a positive effect. So I was wondering how you think about that.
Yeah, I said it before. So in the paper, I still have this credit constraint story written in there, so I don't find that convincing. I give you that. Completely agree. That's why. So what I think I'm picking up, I said in the presentation, I think that's my story, and I don't have any other intuition at the moment. That you could simply, if you had the funds and you could increase bank lending, it was also a way to get rid of reserves, and that's what I think I'm picking up. Because if you think about it from balance sheet perspective, if you increase your lending, and then usually lending is used for something, right? So if somebody is willing to take up lending, they're going to use it, and if they use it to make purchases at another bank, reserves flow from your bank to another bank, reduces your reserves. I think that's the most convincing mechanism in this setting, right? Because it's staggered. It's I looked the banks up, I collected data set myself, and then I was very surprised when I got these results and how strong they were. And I think that's what's driving this, to be honest. Yeah.
So, once again, thank you very much for the presenter, for the discussant. So then, we have the last presentation, Angelika Welte on mobile device users for payments.
Okay.
The floor is yours.
Thank you. So I'm assuming my mic is on. So thanks, everyone, and thanks for staying for the last presentation. I'll try to make that as painless as possible for you. I understand you all have flights to catch or maybe some other things that you want to do. So I'm really happy that I can present our paper, which is called Untapped Potential Mobile Device Non-Ownership and Mobile Payments in Canada. This is joint work with Marilyn Feld and Katrina Talavera. And so both of them were at the Bank of Canada at the time. Katrina has now accepted a position elsewhere. And I also would like to thank the University of Vienna for their hospitality in the academic year 2023-24. Where I think a lot of the work was completed. So the usual disclaimer applies that the views are ours, the authors, and it shouldn't be attributed to the Bank of Canada. So let's go right in. So why are we interested in that? So we find that in Canada, as probably in many countries, smartphone ownership is very high. So on the left side, you see a graph that shows you the number of mobile subscribers. I know the numbers are difficult to see, but these are very close to 90% of the population in Canada, and the pink line tells you the share of those people who have smartphones. So, and the purple one that's nested in there tells you, again, how many of those actually have a phone which has near-field communication capability, which is the technology that you need to use your phone to make contactless payments at the point of sale by tapping it on the terminal. So we see that overall there seem to be very favorable conditions on the technology side and the technology that the consumer has for making payments with your phone. On the right-hand side, you also see that the penetration of contactless payment card terminals is quite high in Canada. So contactless payments have been around for over 15 years in Canada, and many merchants accept them. So further, I think that is a very important point, and I think it came up in some of the other talks. So we also find that the financial institutions, so the issuers of debit and credit cards in Canada, they make mobile paying and mobile banking available. So I think almost every big bank in Canada, and also most of the smaller ones, have a mobile banking app where you can log into your account and make transactions and receive transactions. And the vast majority of Canadians, first of all, they are all banked, and they have a checking account, and they could link their domestic debit card, which is Interact branded, to a mobile payment app. So most banks allow this for the major apps such as Apple Pay and Google Pay. And also the vast majority of Canadians has a credit card that they could also link to a mobile wallet. So overall, we find quite favorable conditions for mobile payments. So everything in terms of the infrastructure appears to be in place. However, what we find is that most Canadians have a smartphone and they do not pay with it. So first of all, smartphone ownership, as like you saw on the previous graph, is around 84%. So there's 16% who do not have a smartphone. However, overall, only 16% of Canadians use a mobile device on a weekly basis and have used some mobile payment app in the last 3 months. So this appears quite low, and especially against the background of what we saw on the previous slide. So let's just look at like how Canada looks compared to some other countries. So I picked the United States and Germany. So we find that the cash share in Canada, it's around slightly above 20% in terms of the number of transactions at the point of sale, quite similar to the United States. But the United States has a very high share of mobile payers, which you see here in green. So interestingly enough, the share of mobile payers for Canada is quite similar to the share of Germans who make mobile payments. However, Germans are way more cash intensive. They used in 2022 still cash for over 50% of point-of-sale payments. So it seems that this story that people aren't using mobile payments because they're paying with cash isn't really applicable to the Canadian case. So we want to dive a bit deeper into that, and that's what this paper does. And because I know that you all want to leave and that people don't like surprises, I'm going to give you the main findings now. So the question is why they're not using it at a higher rate, and what we really try to get at in this paper is whether these are constraints or preferences, right? And we find this important because there are questions about digital inclusion and financial inclusions, and they're closely linked with this access and adoption of payment innovations. We do find that there are also many questions about unmet payment needs. So do people have all the payment methods available to them that they would need to make the transaction that they want to make? And I think, as we also discussed during the break, when people switch to mobile apps or mobile paying, what actually happens to cash? Because as long as you have a physical wallet with all the cards in it, right, you can put cash in there. But I mean, I personally find it pretty difficult to put cash in my phone. I mean, I've seen people put like banknotes between the cover and the phone in case of emergency, but it's not quite the same as having your wallet on yourself. So this is why I think, from the perspective of cash demand, adoption, use, it is quite important to also look at mobile paying. So what we find, though, is if we control for the selection of having a mobile phone, we actually find that 15% of the people who currently don't have a mobile payment would also adopt mobile payments if they could. So this tells us that there might be some unmet payment needs among the people who don't have the technology available to themselves. And this is actually more than twice what we would get in terms of adoption if we did not control for the selection. And in terms of modeling, what we do is we exploit basically differences in cohorts of adoption. So there is the cohort that basically grew up with mobile phones. So I'd say anyone 45 and younger has probably, since they became of age, always had a mobile phone. And so this is not a recent innovation. So we are at a quite mature point on this adoption S-curve, whereas mobile payment technology is a much more recent innovation. So we are still at the stage where it's these early adopters. So and our model, our identification strategy will exploit that. So, but first, before I go into it, I'll as I described in this roadmap, I'm going to actually explain a bit about mobile payment technology and mobile payments and what we cover in this survey. I go into the data, the identification strategy, I'll show you the results, and then I discuss a bit. So what are mobile payments? So, I mean, I think most of us would recognize a mobile payment if we saw it. But it is at points quite difficult to draw the boundary between mobile payments and online payments and contactless payments. So you could say there are payments made from a mobile smartphone or a smartwatch, whatever that is. It can include these digital wallet apps. It can also include mobile banking apps, store-branded cards, etc. So they give us new ways to do what we've always been doing, but do it with our phone. Or with a digital wallet. So, and the question here is, of course, are there now any accessibility considerations? Can anyone use those mobile apps? So another thing that is really important in terms of from the point of view of industrial organization is that we are actually dealing with several platforms that are stacked within each other and have quite complex vertical relationships. So there's like a recent work by Gomez and Le Fouly at the Toulouse School of Economics, who look at how all these platforms interlink, right? So here I try to draw an example, and it got really complicated really quickly. So you have your mobile phone with its operating system and hardware, right? It has let's say it's an Android phone, it has an NFC chip. So here in Austria, let's say I'm with Erste Bank, there's this banking app which is called George. I can install it on there. Then I might have Google Wallet on there, and then I also have a bank account management app for my Canadian bank account on there. And then in Google Wallet, I can have Google Pay, and then I can put in there all my cards, let's say my Canadian cards, because actually you have to choose whether your phone is in Canada or in Austria. And then they are from these networks. But these networks actually, they sit, if you really think about it, at a higher layer. And somewhere in there, there's also Google, who are themselves a platform, or Apple, who we talked a lot about, right? So you have this very complicated stacked structure, and everything has to work together, and you have to adopt all those things to, in the end, make your mobile payment, right? So you can use them, as we said, we can use them online. So there are actually different ways to do that. That is, you basically use a browser on your phone as you use the browser on your computer, and you enter your phone number, or you have apps where you store the payment information. So for example, Starbucks offers a web app, and you can store your payment information in there. And you also can have mobile payment apps like Apple Pay and Google Pay, and they can interact with your browser. So you can use it to make these remote payments. And things like that. You can make e-transfers, the electronic bank transfers from one account to the other. You can do that in your mobile banking app. But you can also use it in store. And indeed, you can use the same payment app in store and online, let's say Apple Pay or Google Pay, because it stores your information in your Google profile, and then it is accessible for all kinds of payment. So one thing that we probably all think about are these in-store contactless payments where you use an NFC chip. So we have 3 wallets basically available in Canada, and I'll show you later. They cover really the majority of the markets: Apple Pay, Google Pay, and Samsung Pay. And there's all these ways to pay with that. I think we know this. So how are we trying to track that? So we use a data set, which is called the Digital Wallet and Payment Trends Survey. It's a syndicated survey by Ipsos. So syndicated means that it is a survey that mainly they design, and then you can buy the data. They mainly control the questionnaire, but we have a very good partnership with them. So we have bought this data set, and it covers adoption of these financial technologies and digital technology. It's like lots of preference, attitudes, habits regarding cash and digital payments, like many of our other payment services, but really with this focus on the digital wallet. And it has, I think, one particular feature: really every single card that the person has. So it's a micro data set. 3,000 Canadian adults per wave, so there are 4 waves per year. That gives you 12,000 observations for every year. And they're collected in 3 months intervals. And for this paper, we use 9 waves, covering early 2021 to early 2023. One reason why we choose this period is that they sometimes make updates to the questionnaire that then introduce some inconsistencies with the questions that we want to use. So we chose this so that the question remained the same throughout the sample period. So here is what type of mobile payments Canadians use. So 16% are mobile payers. Mainly they use mobile payment apps. A few of them also use QR codes. So QR codes are not as popular in Canada as they are in other jurisdictions. I mean, we heard about the Chinese market, so it is mainly these mobile payment apps. 89% use one of those wallet apps, so Apple, Google, or Samsung Pay. Like Apple with 61% is the market leader, followed by Google Pay and then Samsung Pay. And also half of them use a bank account management app. So what's also clear here is that these people generally multi-home, right? So if you add those things up, it's more than 100%. So once people use mobile payment apps, they use many of them. They also use these store-branded prepaid cards, like the Starbucks app, etc. And 65% multi-home use multiple apps. And also the majority of them has a card linked on their phone for in-person payments. And mainly they link their credit card, about 1/5 only the debit card, and another 1/5 a credit and a debit card. So who are these mobile payers? We find overall, probably not quite unexpectedly, that they are younger. You see there is a larger share of about 30% in the cohort that's 80 to 34 years old. We also find that they are higher income, about 20% in the highest income bracket, which probably also makes sense. They're slightly higher educated, and also they are more likely to have been in Canada for less than 10 years. So mobile non-users, on the other hand, are older, and so this is what we're going to exploit. So what, of course, we have, and I know I have 5 minutes left, so I'll try to be quick. We have, of course, a selection or missing data problem, because we never ask the people without a smartphone whether they use a mobile payment app or if they would like to use a mobile payment app. And we believe that these two adoption processes are related to each other, and that it is necessary, if you fully want to capture the demand for mobile payments, to jointly model them. And therefore, we propose to use a model that accounts for this selection problem, and that's what I'm going to show you. Won't go, so all the details are in the paper. So what we use is a probit model with sample selection, which basically simultaneously, so it looks at the joint distribution of mobile device adoption and mobile payment adoption. And the important part is that we allow these adoption processes to be correlated, which is captured by this parameter rho. And if the parameter rho is negative, that means that there is what we call negative selection. So that would mean, and that's what I already told you, that the people who don't have a mobile phone are actually the ones with the larger demand for mobile paying. And in order to identify that, we need something that moves mobile device adoption, but it doesn't move, it's not correlated with mobile paying. And that's where we use these different cohorts. So of course, age, as we saw, makes you more likely to do either. But we have this cohort effect here, which you see on the red line on the left-hand side graph, which shows you that there is basically a non-linear effect of age on mobile using. So as I said, if you're younger than 40 or 45, you have a phone, and then it drops off quickly. Whereas for mobile paying, the effect is more monotonous. So it's almost sort of linear. The other one is quadratic, and that's how we do it. And that allows us to separately identify mobile device adoption from mobile paying. So, of course, we also have observables in there. So what we find is a lot of the observables that we stick into the model, they have the same sign for both, right? So age is negatively correlated, income positively correlated. That's all what you saw in the descriptives. One interesting case is, though, the number of credit cards, which I think already hints a bit at this negative selection. So if you don't have a credit card, then you're actually then you have a demand for mobile paying. But if you have more credit cards, then you also, so it is really the first credit card, the not having a credit card, that kind of reflects your unmet need for these mobile payments. Okay, and then we have these. And then we find this negative selection, which means people without a mobile phone, they would actually really like to make mobile payments. So, and then what we do with this model, we can actually model the counterfactuals. We can show that if we properly account for the selection, we have that 15% of these non-device owners would actually like to make mobile payments. And if we don't account for the selection, it will be 7%, so it's almost double. What we also find is that these differences are more extreme in categories where people are very likely to be mobile users. For example, if you take somebody who is young, 31% of them are mobile users. But of the young people who don't have a mobile phone, you would get like 45% to be mobile payers if you gave it to them, right? So you have this very strong selection effect because there's really something going on with this person, this constraint that they don't have a mobile device that also prevents them from doing mobile payments that they would like to do. And similarly, you see it for the immigrants from Asia or Oceania. So if you gave, so 26%, a very high rate of them are mobile users, but they have also, in the counterfactual simulation, their mobile non-users would have a 32% adoption rate of mobile paying. So So what explains this negative selection? So we already talked about limited access to cards. There could be cash dependence. There could be unmet payment needs. There are financial constraints. For example, in Canada, in order to have a cell phone plan, you need a credit rating. So it could prevent these people from accessing both a credit card and a mobile phone. Of course, for some people, there may be low technology affinity, so I'm going to finish. So I think this is just so who will need new payment technologies? It's not always the people who we think about, right? And if you want to know more about our research, you can scan this QR code, but as Kim told us yesterday, maybe you shouldn't. But maybe you want to. Thank you very much.
So the discussant is Marco Brandi from the Banca d'Italia.
Oops, I always do this.
So I hope that the last discussion will not bother you, but I want to thank the organizer for this beautiful organization, for this amazing conference. And the view, the disclaimer I have to do at the beginning of the discussion. Of course, everything I'm going to say is my personal view, and it's not involved in the Bank of Italy. The responsibility is not from the bank. So Angelica and the co-authors shows these results from this data collected from Ipsos, from the digital wallet and payments used in Canada. And they monitoring the mobile payments, as she showed before. And there are a lot of insights into the paper, so I invite you to read it and to find some really interesting patterns in this data. And the authors also proposed this two-stage probit model in order to find some patterns and determinants in order to model of the mobile payers, non-payers, of course, with the conditioning of the possession of the owning of a smart device, not only the possession they frequently use during the week. In this way, they avoid the possible biased estimation. The main results that for me was very interesting can be summarized in these few sentences, but there are a lot of findings into the paper that I invite you another time to read. And this is very interesting that people that don't use the mobile phone are more, they want to use mobile payments with the rates that exceed the mobile users. So this is, I'm going to discuss also later, but this is probably because maybe the technology is not already prepared or should for these people. So these people maybe don't use the mobile technology, but they want to use mobile payments or something which is similar to mobile payments. And of course, another interesting result is that these digital wallets can substitute the physical wallet. So the mobile payments are not just a substitution of credit card payments, but also cash payments. So in this way, mobile wallets are going to increase their popularity. It's possible that the demand of cash is going to decrease. And there are some explanation from descriptive statistics. And one that was very interesting is that mobile payments are the largest representation in the recent immigrants. So the main reason that which is proposed in the paper is that the adoption of this type of apps in the home country. But my opinion is that this is possible also that is related with remittances, because maybe they can use the same app for the remittances. And the authors that I proposed here, Appiers, showed the mobile money used in the Ashanti region in Ghana. So how they use this mobile money in the SIM card, which is different, but the technology was similar, in Ghana during the past. And of course, we don't have to forget that a share of these remittances follow the informal channel. Ferriani estimate this informal channel, which we can assume that is totally in cash. So if we can observe that this informal channel of remittances is going to decrease during the year, and maybe the adoption of these mobile payments is increasing, so maybe there could be a relation. And also, it should be explained well, because, you know, people that are adopting mobile payments or other payment instruments, they do sometimes with cost relation. So I'm going to use the one who is going to cost less. Regarding the model, I just want to specify that there is a time trend covariate in the model, and I think that if time is important, it should be better to go to panel that you already said that you showed in the presentation. And maybe it could be interesting to see an interaction time between the localities of urban, rural, and provinces. So if there is differences into the provinces from the locality. Regarding the model, the two-stage Ekman-Probit model proposed is widely used in this type of application in the real world, and but of course there are criticisms. The first one, of course, is when linearity is not true. So sometimes linearity is just an approximation, and it is possible that there exist a lot of patterns that are not linear and also complicated. There are proposed a lot of semi-parametric models during these years in the research, and there is this semi-parametric are, you know, like a middle level between the explanatory properties of the linear one and the flexibility of machine learning and new models that are existing. This is just a suggestion, of course. That is the possibility to apply machine learning methods, as Alain Di Loro applied in the Italian revenue agencies data, that they just model the VAT gap, so the difference between the VAT paid and expected in Italy. And they use this gradient boosting, which is an ensemble learners of simple predicted model like classification and regression tree. The idea is similar to the Ekman one. There is the first step, in this case, a gradient boosting classification. And the second step is a gradient boosting regression, of course, because the VAT gap is a continuous variable. So, of course, there is the possibility to use another step of gradient boosting classification, and then is it possible to evaluate the performance, the prediction performance. Why we have to use machine learning methods? It's not just because we want to be fancy or in some way, but usually performances are better in order to predict. And of course, the problem is about the explainability. There are a lot of recent works and also a lot of works in central banks related to explainability machine learning methods. And in this case, using gradient boosting could help us because there is the possibility to compute the Shapley values. Shapley values are something that are similar, if we can compare, with the coefficients of regression. So we have the variable importance, so we can see the magnitude of each variable, so how many important is a variable to discriminate between cases. And Shapley values give us also the sign. So it's like, it's not easy to interpret them. It could be a very good work to do, but we can see the sign also. So which, not only the importance, not only the magnitude, but also the sign. And of course, prediction, as Alejandro Di Loro showed with respect to the Heckman probit two-stage model. It was not probit, just the first stage. The second stage was a regression. They showed that the prediction performance are better than the linear model. Of course, this is because they catch this linear relationship, also interaction between variables. So this is just a little slide about policy implication. So sometimes in this, as a conclusion, some individuals, there is an unmet payment needs. So as Angelica said before, it is possible that there is something that is missing in the payment market for them. And particularly is for the cash-dependent individuals. So maybe there is the chance for a CBDC to go into this little block. There is a chance if we think that a CBDC is built in another way, different from mobile payments, maybe. I want to thank the authors and to lend me the occasion, the possibility to discuss this paper. So they provide this very flexible and comprehensive approach to explain these determinants of mobile payments. And my last question is that, for example, you at the end you say that probably there is something that is missing in the survey to explain the factors of the behavior of mobile users. So you have something in your mind that which are these factors? So maybe to improve the next surveys. So at the end there are some references, and that's it. So thank you to all of you, and that's it.
So last chance to ask questions.
Angelica, thanks very much for the presentation. I'm here. I'm curious, you showed the vertical structure of these, of the setup, and I'm curious to know more about, are there any additional fees when using the Google app? Does Google have to pay now to the banks, or is there any way that any additional fees gets transmitted to the end user? Or if there's no fees, are you simply just giving, let's say, access to your payments data to these app providers? Can there be any story that maybe you don't want to do this, if there's privacy concerns or anything of that sort? Thanks.
So thanks for the question. So I think in the paper we discussed some of that. So generally in terms of direct fees, there are no extra fees to make a contactless transaction with the phone. However, I mean, I think this is what we also try to explain with the access to the mobile device, and especially the devices that have the more advanced technology, that these tend to be more expensive. Right? So we do know, for example, that most the iPhones came also with the NFC, but they are more expensive, and that until recently, some of the budget phones by other manufacturers that would, then be Android phones, they didn't have the chip, right? So I think this is where probably the cost comes in, but in terms of the transactions, I think there's no fee for the consumer. I mean, we are abstracting here from the merchant side. In terms of privacy, yes, I think that's definitely one thing that plays a role. We do have some questions about privacy in the survey. And I think in the paper we have some cross-tabulations that show, people that are more sensitive about that, how that relates to mobile device ownership and mobile paying. Same with in some waves of the survey we know about the credit scores. We try to explore that and see if, and in general, I think your intuition is right. But we didn't bake everything into the model. I think one thing that we do find, though, is that also the attitudes towards cash, they kind of differ for the people who are mobile payers and who are not mobile payers. So I think I've also heard this from people, that a lot of these mobile payers, they see the usefulness of cash. They see it, they find it useful, but for different things. So, so they like cash, for example, for tipping, whereas the mobile non-users, mobile non-payers, they like it because it's universally accepted. So I think this is, and I think it comes back to this, what does that mean for cash, or what you also brought up about other digital payments.
Okay, thanks a lot for sharing your interesting research. I have two questions. So the first one is whether you looked at gender gaps, whether there are differences between men and women, not only in adoption and use of mobile payments, but for example also in perceptions of safety, because we saw that, for example, for the Netherlands, that men are a bit more positive about safety of contactless payments. And the other question is, I think you shared that you used 9 waves. So it's also possible to look like who are the early adopters and who are more later adopters of mobile payments.
Okay, so in terms of gender, so it is definitely a variable in the model. I should need to recall that I think when we basically just look at the cross-tabulation, I want to say that I think women were less likely to be mobile payers. However, for controlling for many of those other things, it was not as significant as a difference anymore. In terms of, I think, your second question, I think it really relates to your comment about the panel dimension. Mm-hmm. I think we would really like to exploit that. I think we're still working also with the data provider and the data set to make that possible and explore how it can work. I mean, the time period is relatively short, and mobile payments were introduced before. I do think what we are also seeing is that, I think in terms of adoption, right, that I think one thing that would actually be really interesting to capture is, and again, in relation to the device adoption, like what happens when people now get access to the technology, or when they can, when they are eligible to, on their mobile contract, to renew their device, if they're going to actively seek out one with a chip, or if it's just going to be that all of them have it. So I think exploiting the panel dimension is going to be really important also for the dynamics of this model. So right now it is quite cross-sectional. We put everything, we put in time-fixed effects, and I understand that there are some problems with that in its own. But yeah.
Okay, thank you.
Are there any more questions? If not, and before I hand over to Martin, let me take this opportunity. I think in the name of all of us, let's thank the Austrian Central Bank, especially the two Helmuts, Helmut Stix and Helmut Elsinger and their team, the ladies in the back, the others behind the counter of the beverages, with a big applause for all. Now, Martin, last words from you.
Can you send me your slides?
Yes, of course.
Of course. Thank you so much.
Dear colleagues, it's my task now to officially end the 13th Economics of Payments conference. I hope you agree with me that this was really a great experience and a great event. And I am very grateful also for all the positive feedback I got from you in conversations and in the coffee breaks and so on. And I'm really glad that so many of you like this conference. And I would like to take the opportunity now again to remind ourselves that this was only possible because, of course, the great input by our presenters, discussants, and our keynote speakers, Charlie Kahn, Neha Narula, Jean-Charles Rocher, and Piero Cipollone today, and of course the brilliant work and hard work of Helmut, and the program team, who did a really great job in selecting exciting papers and engineering such an interesting program, especially this combination with the technology conference. I thought worked out really well. It was an adventure and experience, and a very good one for me, and I hope for you as well. Now, you might have observed that this conference went, in terms of process, extremely smoothly and well organized, and for this we are completely dependent on our brilliant event team, and I want to express my deepest gratitude to Susie, Karina, Birgit, and the colleagues, the technicians, the kitchen, and the printers who produced all these beautiful posters. Thank you very much. We are extremely grateful for your support, and you help us really to make a good impression with our colleagues from abroad. Thank you very much. Finally, before I close, I would like to remind you that material from the conference, videos, presentation, and so on from the last 2 days are already up on the web page, and by Monday you will have the complete experience that you might rewatch or share with colleagues. And with that, I thank you again very much, and I wish you a really good and safe trip home and a nice weekend. Thanks so much for coming.